a modest rate cut going ahead. That uncertainty has landed the 10-year at 4.02. Crude is continuing to ease. Now, a couple of reasons here. We've talked about how OPEC Plus expects lower demand through the rest of this year. But on the other hand, Israel's retaliation on the fear that they will retaliate on Iran's oil bases has receded. They now have said that they will focus on military establishments of Iran when they retaliate. The Brent is now below $75. Asia, meanwhile, has opened higher, largely following US cues. The Nikkei is an exception there because the export data has missed estimates for this month, and that has been a bit of a downer. China, I want to pull up. Let's just say Shanghai and the Hang Seng markets, because the Chinese housing minister has put out a statement just a short while ago talking about how they're going to be boosting the housing market. And this is a series of statements that have been coming out from China. So more of the same, 1.5% now up on the Hang Seng. Implied open, though, is not looking like a very exciting day. A bit of a muted start. Flat actually now, but down in the red as per the current implied open. And that's largely because you're seeing no big momentum boost coming in terms of the earnings either. Fund flows have also been a drag, a continued drag. The quantum of foreign flows which are going out have reduced but continue nevertheless unabated. 3,436 crores of fund flows, outflows from foreign investors. Domestic investors, meanwhile, coming in and buying 2,256 crores in yesterday's trade. So all in all, Samina, I would say that another muted day on the street.
Unless China actually goes out and announces that big bang stimulus for the markets. The briefing is underway, so maybe you'll have some commentary that comes in even before our markets open up. But until then, traders may remain on the sideline. But it's been a very sort of buy the dip but sell the rally trend in the markets. What we've been lacking is follow-up buying at every sort of uptick that the street has seen. So let's quickly recap what happened yesterday, and then we'll talk about what we should be looking forward to in today's day of trade. Yesterday again was a day when we didn't have too much support from global markets. We came into trade threatening 25,000. Midday trade, we dipped below those levels, and finally ended trade sub 25,000 on the index. Now the bulls have been defending this mark for the last few days, but the trading range very clearly is 24,000 on the 24,900 on the downside and 25,200 on the upside. So every time we get closer to 24,900, the buying comes in, but sell calls go in at 25,200. Auto has been on a weak leg, and that could be one big reason which impacted the markets. The reason that's happening is because you have that big subscription open for Hyundai, which closes tomorrow. So anybody with an auto allocation, auto funds, what they could be doing is reducing the allocation of stocks like Maruti and M&M and actually going out and subscribing to maybe a Hyundai. So that could be one reason why auto has been under selling pressure for the last two trading days. IT as well, numbers have not been too bad from the tech pack. We haven't really seen activity in this sector. Anticipation was that after HCL Tech posted numbers that beat street expectations, you would see the counter do well. But that's not happened. It continues to trade at its record highs, which it hit even before the earnings were reported, but no conclusive moves coming in on any of those tech counters. But again, today tech will be important because you've got earnings from the likes of an Infi and a Wipro. Wipro also has that much awaited bonus issue. So action could take place, and today could be one day, but the flip is tech in the US has sold off. So watch out for this space. It could be range bound with a positive bias in today's session. RIL bounced back yesterday, and HDFC held on to gains. So those were two counters that supported the market on the downside. HDFC Life had a pretty phenomenal run despite selling off 3.5% post its earnings. Brokerage commentary and growth outlook in the press conference is what lifted the counter. It also went on and lifted the whole pack really. So all your asset management companies, broking companies actually did quite well in trade yesterday. Sugar stocks had it bad. Stocks like PNC Infra, Ashok Bilkorn have been gaining significantly from the Maharashtra state government, and that boosted these mid-cap names. Apart from that, a quick update on the Hyundai IPO has been subscribed 0.42 times, which converts to 38% of the book is now subscribed at the closure of day 2, which was yesterday. Well, that's what we had yesterday, but as we go on a trade today, like I said, it's going to be a range-bound day of trade. Consolidation will take place. The Nifty will attempt 25,200, will find support at 24,900. Bank Nifty is done okay, but 51,900 seems like that level that traders are very closely tracking. That gets taken up, then you may head over to 52,050. But apart from that, Bajaj Auto, L&T Tech, Mphasis would be responding to their earnings. Infi, Wipro, Axis Bank, Nestle will be reporting their earnings. So it's an earnings-heavy day, and hence it becomes a very stock-specific or stock pickers market in more ways than one, Tamanna.
Yeah, absolutely. So just a quick look at some of the big numbers that you will see coming out today before we go to the trade setup, and then the stocks that you need to watch out for. For one, Axis Bank, Central Bank of India. So some of that BFSI pack will be in focus. Remember, the big ones come out later this week and over the weekend. Havells India is one to watch out for. Mphasis and Wipro, as Samina mentioned, will be the other ones. LTI Mindtree as well. I would also watch out for a Nestle India. Good set of numbers last quarter, despite all of the baby food kind of a furore that they saw. But the numbers were decent. Do they continue that or not is what we need to go out and see. Polycab India, Tata Chemicals, Tata Communication are some of the others that you need to watch out for as far as earnings go. So earnings heavy, Samina, and that's really the story. I mean, the volumes and the enthusiasm seems to be lagging.
Yeah, maybe we are so used to excitement and momentum that anything stable, even if it's range bound, seems to be disappointing. But like Tamanna said, I don't think the guts amongst the bulls is there right now. Just a quick check on the wicks. Let's take a check of how that was, because the markets were fairly volatile. While the range was close and tight, the wicks had seen a marginal uptick. So at 13, traders also not too convinced about the outlook. And of course, it's all about earnings. We've already highlighted for you. A bunch of companies will report. But let's quickly take you through the stocks that we should watch out for. So there'll be earnings reaction, right? You had Bajaj Auto that reported numbers post-closing yesterday. So this could be one auto counter that may see some interest in today's day of trade. It had its best ever quarter, like they say, and revenue and even operational profitability in the second quarter of fiscal 2025 was a beat to the most optimistic expectations. Revenues were up 22%, EBITDA was up 24%, margins have improved as well to 20.2%, net profit came in higher by 9%. They've managed to maintain margins about 20% for the fourth straight quarter, and that is what investors want to hear and want to take heart from. Remember, auto companies in the last few months have been seeing a declining revenue share, market share. In fact, what is working for this sector, and that could be another sort of added positive, is the fact that we've gone into festive season on the 3rd of October. So 32 days of festive demand is only going to help a counter even more like Bajaj Auto. PAT came in at a record high. The Chetak has clocked about 1 lakh units, but it's not contributing yet to its top line on the EV space. Green vehicles now account for 40% of domestic quarterly volume. So all in all, good earnings. We will, of course, do a deep dive on this over the course of the next hour. The other one that reported from the tech pack was L&T Tech, largely in line with expectations. So nothing amazing in terms of what was reported. Revenue was up 4.5%, EBITDA was up 1%, margins actually reduced at 15.1 versus 15.6. Net profit was higher by 2%. They've maintained their guidance, saying that 8 to 10% of growth is what they're expecting in constant currency terms. Their revenue currently stands at $2 billion and margins of the range of 17 to 18%. An uptick in margin is what the company is expecting in the second half of this financial year. They won 2 big deals, and they won 4 large deals to the tune of $10 million. And of course, they also got impaneled on 2 boards in sustainability. So maybe some positives, but on the face of it, the numbers largely in line with expectation. The stock may not get a strong sort of welcome this morning because they've not really impressed any of the quarters of the market. I'm going to pick up one more, which is not earnings related, but it's largely Maharashtra state government related. Yesterday, we saw the number of order wins that came from the BMC and MSRDC. Today, there's one more. Yesterday, the day belonged to RailTel. Today, of course, it's Rail Vikas Nigam that has backed an order for 270 crores from the Maharashtra Metro Rail. Tamanna, you missed this yesterday, but we were discussing how the Maharashtra state government is coming to the rescue of every EPC player. They came to the rescue of RailTel yesterday. It was an 80 crore order. The stock, of course, rallied up. You had PNC, you had GR, you had Ashok Bilkon, and now, of course, Rail Vikas Nigam this morning.
I would look at it in the context of the dates that have been announced. So no new orders can be given once the model code of conduct comes in, which actually came in from yesterday.
Okay, so this could potentially be the last order that they've given out.
This
okay,
is the
so the
order
party is
flow.
over now.
The party is over, A, and B, will the party continue? Depends on the outcome of these elections. That's the only question mark that I would put there, because unfortunately that's how our...
but for now, this is a done deal, right? These deals cannot go out and be rectified or changed in that sense,
if another government comes in, they could choose to. They could choose to. So everything is up in the open. So which is why markets react so actively to election results. This is the
one
example
of the reasons why,
of why.
because continuity could mean that these orders stay and more orders.
Correct. For any company which has bagged an order, to think, will this happen, will this not happen, is a tough way to do business. So these would possibly be orders which have been inked before the Model Code of Conduct came in.
Yes, RBL was yesterday, so I think that's pretty much capping out on that now.
So this is all capping out. You're not going to hear anything from Maharashtra government or the Jharkhand government for the next 1 month, because those two, election dates have been announced.
I think PNC was one of the big gainers in terms of what they've bagged in Maharashtra, and I think Ashok Bilkon as well. But yeah, those are what you want to watch. Rail Vikas today potentially could be the rail tell of yesterday.
Yeah. Just on Bajaj Auto, just want to add a couple of things which I found interesting in the notes, because numbers good on the face of it, but MK, for example, has chosen to downgrade Bajaj Auto to a sell from a reduce. With a target price of 9,500. The reason is that they find the ASPs, the average selling price, to be weaker marginally. So they find Q2 muted. And one point from Jefferies, which I found noteworthy, is that the growth is strong, but a slight miss in Q2. They've still retained a buy with a target price of 13,400, so an upside of 15% actually on the face of it. But if you look into the details, they say the gross margin has actually contracted on higher share of lower margin electric two-wheeler, and there's pressure coming in the 125cc segment. Exports continue to be a pain. So just that sort of tempering point on Bajaj Auto. But some of the stocks that you need to look out for, gas stocks, I would say, could see a big negative. A lot of thumbs downs on my list today. So gas stocks under pressure because the government has cut domestic APM gas allocation to city gas distributors. The estimate cut in allocation at 4 million metric standard cubic meter of gas per day. So basically by around 20%. What is this? This is the gas which is under an administered price mechanism. So it's a price controlled portion of gas which was supplied from ONGC oil fields. For example, the proportion of this sort of controlled priced gas has come down by 20%. So that's a negative clearly for city gas distributors. Because they're largely used in the CNG segment. So you can expect CNG prices to go up. These gas prices help companies control their operational costs, and which is why there is a negative. Who is this impacting? An MGL, IGL, or GGL today? Citi says that the lower APM gas allocation is negative for gas companies. No reversal in move to lead to gas companies sourcing gas from international markets, which will clearly be at higher prices. The current APM gas price at $6.5 a unit versus spot LNG at $13 to $14 per unit. So there is a huge kind of a bump up in cost that these companies could face. The move could increase cost of gas in CNG segment by 4 rupees per standard cubic and possible necessity for a 5 rupee per kg hike in CNG prices. This will impact volumes, and CGDs, that city gas distributors, will voice their opposition to the move. So it creates uncertainty around government's priority for the CGD sector as a whole. So that there could be a rough morning for some of these companies.
I did catch up with Mphasis a few minutes ago, so we'll quickly highlight those earnings as well. They did come in at 12 a.m. in the night, so of course you may not have too many brokerages just yet commenting on them. But the numbers were okay. They were largely in line with what was expected. Revenues have seen a single-digit growth of 3.3%. EBITDA is up 6%. I think one standout, on the only standout for Mphasis this quarter, is the fact that they've committed to increasing margins and improving margins, and they've successfully done it. So they've improved margins to the tune of 15.4 versus 15%. That's largely because 20 bips of that margin improvement has come in on back of forex gains. So on back of the rupee weakening in the last quarter, you have seen some gains on the cross-currency impact of this. 20 bips has come in on back of operational efficiency. So those are the two aspects that have helped the margins for Mphasis in this quarter. Net profit was up about 4.6%. their deal wins continue to stand at a record high of 207 million. But what we do understand is that these are not long-term deals. So they've picked up a lot of work which is short-term in nature, which also means that these are deals that are not sticky. So they come on board, do the implementation on AI and move on. Management said that they would have liked to see a lot more activity, but with the uncertainty on the presidential elections, the fact that there's so much of geopolitical stress, clients are still unwilling to commit. And also remember that 47% of Mphasis book comes from banking and mortgage. So with the rate cut that we've seen and the likes of JP Morgan reporting phenomenal numbers, these are some of the clients, right? So you would see an impact of this, a trickle-down impact of this on a company like Mphasis. So BFSI not doing too badly, and one of their large clients, which they can't disclose to us, is JP Morgan. They've committed 17 billion to improving tech. Now, whether... Of course, when I asked Nitin about this, and he said, oh, we'd love to have all of it, but the fact remains that they are hoping that they increase wallet share on JP and the likes of the other BFSI clients. But for now, decent numbers, margins are better, but 20 bips of that is really cross-currency gains. So it's not like business is getting better or they're bagging deals that are better margins.
So it's been 2 quarters of waiting for those green shoots. And
2 years.
2 years actually, but two quarters of at least saying, okay, green shoots are coming. So are we seeing it? Not yet. Is the big takeaway. So Mphasis is one to watch out for. Bikaji is the other one that we're tracking this morning. So their food arm has acquired Hazelnut Factory Food Products. It's their second acquisition in this year alone. So it has to be seen in that context. The arm has acquired a 53.02% stake in Hazelnut Factory Food Products. It's for 131 crores. It will be completed in tranches over the next 2 years. The company aims to expand into premium bakery, patisserie and cafe segments. Now, this company that they've acquired, Hazelnut Factory, operates 6 stores in Lucknow and offers specialty coffee, artisanal sweets and a cafe menu. This clearly is Bikaji diversifying its portfolio and leveraging cross-selling. It may also strengthen its presence in the QSR market.
Tamanna, just a few more earnings I want to add, and I know this is a smaller company, but I think it could see a pretty decent stock reaction today. Is Pondy Oxide. It's a 11,500 crore market cap company, but the numbers are really good actually. Their profits are up 168% year on year. Revenues have also grown 46%, and it seems like there's been a significant margin improvement as well. So, like I said, it's a broader market play, but very strong numbers. Should see some movement on back of those earnings that they reported. The stock itself in the last 1 month, the chart is on the screen, has done okay. But of course, you want to keep that on your radar. And along with that, you also have Aditya Birla Money. They reported numbers. Profits have jumped about 124% to 26.7 crores. And you've also seen revenue growth of 31%. So on AB Money and Pondy Oxide, numbers were good. Crisil numbers were also fairly good. Margins have expanded. They've declared an interim dividend. Profits have jumped. Revenue has grown in double digits. So all in all, if you're an investor in any of these 3 companies, you would be pleasantly impressed and pleased this morning.
Yeah, okay. Just let me finish off my stocks list. SRF is the third one. Expect some pressure, double downgrade from UBS is what SRF has got to sell from a buy. Previously, the target price has been cut to 2,100 versus 2,700 earlier. That's an 8.8% downside. What they're worried about is demand recovery in the chemical segment will be disappointing. They expect agrochem demand environment to remain difficult and market share shift towards Chinese manufacturers. So they've cut, in fact, their FY25 and 26 EPS estimate by 20% and 22%. So harsh, the SRF was already feeling the pressure. And with a resurgent China, you can expect more of that as far as chemicals are concerned.
That space is tough. I mean, we saw for a change, Rallis did okay, and we saw a really good reaction to the stock because they reported earnings, unlike its peers, that were better than what the street wanted. A quick update on Cochin Shipyard. We brought this to you yesterday, where they were looking at an OFS of 5%. So the government was looking to divest 5% in Cochin Shipyard. It was a 2.5% stake sale plus the offer of a green shoe option of 2.5%. Got subscribed really well from what I understand at 2.5 times yesterday, on back of which the stock was down 5%. From what we understand, they are exercising the green shoe option today. So what they will do is come out and sell another 2.5% at a discount to market price, and there's a good possibility that that will be subscribed to. So that's what you want to keep in mind, and this is the Cochin Shipyard update. The stock could see another morning when it may correct up to 5% in trade. But the big reaction from the Nifty 50 will be Bajaj Auto. Remember, Auto has been on the sell side for the last 2 days, but Bajaj Auto reported numbers after markets closed yesterday, so the stock would be reacting to that today. They've seen an uptick in profit despite a 200 odd crore one-time impact. Revenues have also risen 22%. Margins have been maintained about 20% for the last 4 quarters. Puneet is standing by with more on this. Puneet, on the face of it, these are really good numbers. I would imagine that the brokerages would be pleased, but from what I understand, like Tamanna also mentioned, not everybody is too happy with what they've seen.
Well, definitely. I think you highlighted the key numbers. So it's highest ever revenue and highest ever EBITDA in one particular quarter. Rightly said, 20% in the last 4 quarters as well. So that's another big positive. Net profit was affected, 9% growth. It was expected 20% growth in profits. And that's largely because of the one-time impact of 211 crores. That's because of withdrawal of indexation benefits on debt mutual funds as per the new Finance Act of 2024. Now, the company had highlighted that this impact will come in Q2. Just the quantum has come now. There's also another 580 crore impact on the consolidated numbers of Bajaj Auto, and that's mainly because Bajaj Auto owns a 49% stake in one of the subsidiaries of PR Mobility AG. Now, this company is listed in the Swiss exchange and largely handles the brands such as KTM as well as Husqvarna. Now, PR Mobility AG reported a 175 million euro loss in the first half of FY24, and Bajaj has recognized, the loss of about 580 odd crores based on the stake that they own in one of these subsidiaries. They have mentioned that the outlook is slightly negative for PR as well as the brands it operates in, especially in the USA. So that's one of the major impacts. But they've said that will only impact the console numbers. Standalone domestic business as well as the export business of Bajaj Auto remains unaffected. Apart from that, key conference calls highlights was the main thing that I want to talk about. They did mention that volume growth was very strong, but the outlook they've slightly given a caveat that they're expecting a 5 to 8% growth for this year, and it's at the lower end that they're expecting, and that's because of the first 10-12 days of the festive season has largely been muted and not much growth compared to last year. They have reported a 12% growth on an overall basis, but the retails have been slightly lower, and the company has also mentioned that for EV as well as the three-wheeler market specifically, electric three-wheeler specifically, they have mentioned that the business is flat to positive on an EBITDA basis. So this essentially means that the consolidated EBITDA is not getting impacted now because of these businesses, and that's one positive. But as Tamanna highlighted, 130 basis point impact on gross margin because the lower price variant of 96,000 for Chetak is getting sold much. It has a 21% market share, now the number 2 player, and the company has they are willing to go for the number 1 position if it impacts profitability in the short term. So that's another indication that they are giving. So it might be slightly negative for Ola Electric. Management is focusing on gaining leadership, is the exact words that they used. On the CNG bike, another key positive, they mentioned that they're expecting 18,000 units sold to sell in October versus 10,000 in the previous month. Production increasing to 30,000 in Q3 and 40,000 in Q4. Another big positive. The bike has got response. Finally, on guidance, they are expecting a 10% growth compared to the previous quarter. Revenue and EBITDA growth will be higher than the volume growth in this particular year. That's also led by the export dollar that they have in favor. Brokerages, you did highlight Tamanna, but Nuvama has a very interesting thing. They are building in a 43% CAGR in EVs in the next 3 years. They sold 70,000 in Q2, so that's positive. And on CNG, they are estimating roughly 2.5 lakh units to be sold in FY27 and 80,000 this year. So overall, it's a big thumbs up. It's only valuation that certain brokerages have. MK City don't like the valuations. Nuvama and Jeffries do like the valuation. That's another thing. But overall, business-wise, it's a big thumbs up. Back to you.
Right, Puneet, thank you very much for that. In fact, this is a green shoot that we talk about in the consumption space, and Bajaj Auto keeping up to that. Despite a one-off hit, the numbers look good. And the fact that they maintain margins is another big relief coming in for the street or for investors in that sense. It's an expensive stock, but the fact remains that you pay more for quality these days. Well, in the meantime, it's expected to be a tepid start on these streets, so don't expect too much in terms of market open, despite the fact that global cues are rather positive. It's going to be all about earnings, and there will be consolidation. So maybe an attempt again at 25,100 is what we should be expecting. Well, banks have been, sort of a key contributor over the last few days, and we, of course, kickstart the banking earnings season with Axis reporting numbers today. Harsh is standing by with more on that. Harsh, what do we have? Most brokerages at an average believe a single low double-digit growth is what's likely on back of very tepid loan growth and other income. Is that how you feel? Is that what you've heard as well? Nothing, no fireworks really for Axis this time.
No, not really. Steady would be good, Samina, especially given the kind of environment that we're seeing on the growth front. But let me first take it to NII. Your net interest income largely expected flat on a sequential basis. Margins will hold the key. Can it hold 4% will be the real question. So that's the first piece of it. If it can hold 4%, I believe you're going to have largely in-line set of numbers. Margins will hold the key. With regard to operating metrics, your operating profit hopefully should start to see some bit of operating leverage, and therefore a 2% sequential growth in operating profit is what the average analyst expectation on the street currently is. You're going to, if anything better than that in terms of operations, OPEX ratios, if they have improved, that will be a key positive again. Third is provisioning. You've got 2,000 crore of provisions which have already been upfronted in Q1. How Q2 pans out is going to hold the key, because if a higher credit cost were to come through, that will tweak the FY25 credit cost guidance and therefore cause a bit of concern with regard to asset quality as well as how investors will view this one. Profit after tax essentially expected to be around 6,500 crore given all of these factors hopefully play out. You're expected to see loan to deposit ratio get better with deposit growth ahead of loan growth. So loan growth expected to be tepid, just about a double digit, maybe 10, 11 to 12% odd loan growth is what's expected. Deposit growth expected up 3% sequentially. And how much does that eat into margins will also hold the key. So loan to deposit ratio to come off likely. And that's the other key positive, which hopefully should play out this quarter.
It's not going to be easy peasy from the sound of it for the banking pack. But lots to watch out for with Axis reporting numbers. It'll also give us a cue and trigger of what we can expect from the whole pack going into the quarter. But Ashutosh Mishra, Head of Research of Institutional Equity at Ashika Stockbroking, now joins in. Ashutosh, good morning. Thanks for joining us. Ashutosh, what is it looking like? It seems like net profit around 6,330 crores, which is an 8% uptake YOY and 5% Q on Q, is the sort of average consensus that brokerages have. Loan growth has been tepid and so has other income. What are your expectations?
So, good morning. If you look at Axis Bank, most important things, two important things which we'll watch out for. One is the NIMs, where the NIM territory will be heading from here onward. What we are seeing from the last few quarters is that deposit growth is much higher than the credit growth. And bank is trying to normalize their CD ratio, and impact of that will be felt in this quarter, I think, a more pronounced way. And that's why NIMs will be very important to watch out for. Second important things we'll watch out for is the normalization of the credit cost. What we have seen from the last year to this year, banks is guiding for the normalization of credit cost to the more average level compared to the very low level which we were seeing in the whole of FY22 to 24, if I say, out there. So these two are the important things to watch. Another important thing for the Axis Bank will be how the benefit of city integration, whether that will start flowing in or not.
Ashutosh, hi, morning, Tamanna here. Just wondering what would be the one factor that would be a positive surprise for you when it comes to Axis? Would it be loan growth better than what is being penciled in? Because that really is being expected to be tepid.
Yes, so if the loan growth come better than that, that will be good. But most important, if they're able to maintain the margins above 4%, that will be the best surprise for us.
Ashutosh, how do you feel about operating profit? Do you think operating leverage will start having a little bit of an impact from this quarter, or it still seems like we're a few quarters out to see that impact?
So one more thing which is happening on the operating profit, especially across the banks, that they are not able to recognize the treasury profit in PF from 1st April 2024. And because of that, we are seeing that other income growth to expected to remain muted. So on operating profit, because of this expectation of muted NI and muted other income, we don't expect any major positive surprise on operating level.
Ashutosh, in terms of provisioning, I mean, that upfronted a big chunk of that of 2,000 odd crores in quarter one. What are you expecting on provisioning this quarter? Do you also feel like the higher credit cost could come through, and could there be an concern on asset quality as well?
So yes, we are expecting some moderation in the provisioning expenses from the level which was there in the last quarter. Approximately 2,000 crore was the last quarter, so we are expecting roughly 16 to 1700 crore in this quarter. It will come like that. But if you look, most probably they will keep it up at least higher in this quarter and may guide for the lower provisioning expenses in subsequent quarter out from here.
Ashutosh, I also want to talk to you, and I don't know how closely you track this. Of course, Axis and all the banks in play, but the capital market stories which have been firing, at least in yesterday's trades, UTI AMC, Nuvama, HDFC AMC, of course BSE with its own troubles, but CDSL, etc. Are you seeing a consistent change over here, a fundamental shift over here, which is something you're positive on?
Yes, so capital market stories are building up quite well, and given the financialization, the trend is picking up in a much greater way. If you look at addition of the demat account in the last 2 months, was absolute number was one of the highest. So that trend continued to gain up quite well, and even concern on the earning is much lower compared to what we are discussing about the banks. Investors are focusing toward that segment in a greater way. What is more negative, especially for the banking sector as a whole, or what we are concerned about, is that the whole of the banking sector in the last 4 years has linked their loan, maximum of them has linked their loan to the EBLR, and that to EBLR of the repo. What we are expecting that there can be cut in the repo rate going forward from here, and in that scenario, we may see margin coming under the pressure in coming quarter post RBI cutting the repo rate. So that is the biggest risk, and which is not there in the other part of the capital market players and other things. So that way, surely NBFCs and capital market players are relatively better looking, attractively placed compared to the bank at this point of time.
Very lastly, Ashutosh, what is your pecking order for banks, PSUs included, ahead of earnings? Where are your preferences?
So my preferences is to IndusInd Bank on top, followed by HDFC and Axis.
Right, thank you.
In a public sector, we still like SBI to be the best bet among them, and second one will be the Indian Bank.
Yes, there was no HDFC Bank, or did you say HDFC Bank?
Yeah, HDFC Bank.
Okay,
yeah.
So it's HDFC Bank, IndusInd, SBI, are some of the banking picks coming in from Ashutosh. Thank you for joining us this morning. We'll slip in a very quick break. We'll come back. Implied Nifty is indicating to a flat start, but we'll take you through all the F&O action as we gear up for trade this morning.
Welcome back. This is the India Market Open. We are looking at the futures and options space, how things are panning out there. And at the moment, we are looking at lack of cues. But I'll start off with the implied open and how things are looking there. Where it's flat movement, flat start is what the implied open is indicating, at least as far as the Nifty is concerned. Consolidation largely on the cards, and not unlike what we saw yesterday. Sure, we did see the Nifty come off by around 0.3%, pardon me, but well, we're still having around the 25,000 mark, something that we have been anticipating over the previous few days as well. Very little change in open interest. The Bank Nifty, the picture isn't very different either. That's where we're seeing again a very marginal cut, just below the mark of 52,000, and very little change in open interest. Today is the weekly options expiry for the Nifty, and while there is quite a bit of writing around the 25,000 calls and puts, on the lower end, we're seeing a little bit more put writing around the 24,500 and 24,600 puts, and on the higher end, we are seeing a little bit more traction around 25,200 levels. Of course, that said, we have seen a very mixed day of trade yesterday in terms of stocks as well. And, we've seen some shorts in ICICI Lombard and Coforge, and, well, longs in names like HDFC AMC. On the other hand, in terms of stocks which are seeing unwinding, we have short covering for names like Divi's Laboratories, Siemens, as well as Cummins India. So we're keeping an eye on a whole host of these companies. But let's take this conversation forward as to what we can potentially do with these markets right now. We have Rahul Ghosh of Hedge.in who joins us on the show. Rahul, good morning and thanks for joining in. Let's start off with your assessment on the markets, Rahul. How are you looking at things pan out from here onwards?
Good morning and thank you for having me. Currently, where Nifty is poised, it is currently in a no trade zone. The two levels are very clear. If Nifty closes above 25,250 is when one can initiate a long. If Nifty closes down below 24,800 is where one can initiate a short. Between 24,800 and 25,250, we are in a no trade zone. This is where we've been consolidating with Nifty trying to test 25,250 multiple times, but failing to do so or close above it. Similarly, with respect to Bank Nifty, it's looking stronger as compared to Nifty, but below 50,000, below 51,500 is where we expect some pain to come in Bank Nifty, at least for this month's expiry. Keeping that bearish view in stance, we've planned a simple bear put using the monthly expiry of Bank Nifty. Okay,
this is assuming that you see the Bank Nifty breach certain levels. Only then do you actually go ahead and deploy the spread that you're talking about, Rahul?
Yes, you're absolutely right. So 51,700 is where Bank Nifty closed yesterday. If you see Bank Nifty going below 51,500, then we would suggest initiating a bear spread where we would buy the 51,000 put option of the October end expiry and sell the 50,600 put of once again the October end expiry. It's a simple bear spread where it is limited risk and limited reward. Owing to only about 11 trading days being there in the month of October, premiums are on the lower side, and hence the risk in the trade is actually lesser than 1,500 rupees with respect to this one. When does this trade make money? As any bear put spread, when Bank Nifty goes towards the downside, anywhere below 51,300 all the way up to any point on the downside, the trade would make money. The capital required for the trade is extremely low, about 20,000 rupees. And hence one can look for a return of about 3 to 4% as there are only 11 trading days left in the series.
Right. Rahul, just a follow-up question on the Nifty as well. You suggested that if we do see a breach at the 24,800 mark, in that case, do you suggest that there could be a bear spread that could be deployed there as well?
That could be the case, but Nifty has quite a bit of put writing at 24,500 and 24,000. And there's constant sector rotation happening, as a result of which we found it more comfortable to give one in Bank Nifty. Also, there's a pattern in Bank Nifty. I don't know if y'all can notice. 2-3 days Bank Nifty goes up and then Bank Nifty again becomes weak. And the last 2 days, if you notice, Bank Nifty has been on the stronger side. So today we expect it to be on the weaker side. We've additionally given a level so that we are sure that that trajectory is indeed there, but we would prefer to make it on Bank Nifty as compared to Nifty.
Okay, Rahul, we'll leave it at that. Thank you so much for joining us and taking us through your views on those two key benchmarks that we can keep an eye on. Of course, don't forget that if you do have any queries with respect to the futures and options space, we surely will take them up at 10:30 on the F&O show today, and you can write to us on the WhatsApp number that's been flashed for you on your screen there. So if there is anything that you'd like to know over a position that you've already taken or are considering taking one on, please do let us know, and we certainly have your queries well addressed. With that, it's back to you all.
All right, thank you for that, Agam. Our other focus this morning is also going to be the IT sector, with Mphasis and Wipro both set to come up with their second quarter earnings. Remember, IT companies under pressure in yesterday's trade, the Nifty IT down over 1%. What is expected from the two majors? Rucha joins in with more. Yes, Rucha.
Thanks, Tamanna. Good morning. So you rightly mentioned the two IT majors set to report its second quarter results today. Well, talking about Mphasis, the one main point which I want to highlight is that the street has already baked in a 50 basis point increase in the guidance. Now, remember that Wipro has guided for 3 to 4% of revenue growth for FY25, and therefore they now expect this to increase to around 3.5 to 4.5%. Now, second point is here that the wage hike will largely impact the margins. So, what are the wage hike decisions when the when the company is expecting to undertake wage hike is another point to be looked out for apart from the margin. And the third one is the deal ramp up trajectory. Well, there was a problem in IT space wherein the deal wins were not getting converted into revenue. Whether this has improved now because of the rate cuts in the US, and therefore clients looking forward to more IT spends is what is to be watched out for. And last one is the banking space. Well, Mphasis and many other IT companies receive majority of their revenue from the banking space. Well, TCS had reported a muted growth in terms of BFSI space. So definitely we'll have to watch out for where Mphasis lies in this space. Well, talking about numbers, lastly, revenue expected to rise around 3.5%. Margin expected at 21.4 versus 21.1, largely flat over here. Net profit expected to rise by 7%. All this on a quarter-on-quarter basis. But let's talk about what the street is expecting for Wipro. Well, one thing to be watched out for in terms of Wipro numbers is the Capco business. Now, Capco is the consulting side of Wipro, wherein clients largely spend on discretionary expenditure, and this is what makes the growth in Capco. Now, if Capco is positive, this means that clients are spending and the outlook is positive. But if there is a muted or a negative growth in Capco business, we'll definitely know that clients are still cautious because of the macroeconomic uncertainties. Second point to look out for in Wipro is the third quarter guidance. Now, remember that Wipro guides on a quarterly basis. Well, the street is expecting the guidance to be at around negative 0.5 to positive 1.5 for the third quarter. And lastly, wage hikes again expected to impact margins. So what are the plans of the management is another thing to be watched out for. Quickly talking about the numbers, revenue expected to rise by 1.4%, margin expected largely flat at 16.3 versus 16.5% last quarter. Net profit expected to fall around 0.2%.
Right, thank you for that. It's going to be a busy day for you, Richa. We've got a whole bunch of reaction to those mid-cap tech earnings, and two big ones, Infi and Wipro, both will report today. Well, Nirav Ashar, head of equity research analyst at Latin Manhandal Securities, joins in with his fundamental view on the markets. Nirav, let's start with mid-cap IT, because I think most of those earnings are finally behind us. We had Mphasis and LTTS. Today, of course, you had a bunch of the other ones that were reported in the early part of this week. What have you made of mid-cap IT earnings this quarter? Any green shoots, any hopes here? Would you be buying into the sector?
Good morning, and thank you for having me on your show. As far as the mid-cap IT space is concerned, we try to understand from the large cap commentary. That is very important. So in the case of TCS, we have seen that there has been some pickup in discretionary spending, and the BFSI space is looking quite good. Plus the India demand has been quite strong. Similar kind of commentary we have seen from Mphasis yesterday. I think there's been a slight improvement in the performance also. A part of it is attributed to the currency factor, etc., operational efficiencies. But overall, still the commentary appears to be positive, a far cry from what we have seen in the past. But LTTS again has been a disappointment on the margin front. So it's been a kind of a mixed picture as far as the mid-cap IT space is concerned. But yes, considering the fact that there is some positivity around the recovery in the BFSI segment, we have seen stocks like Mphasis persistent perform well in response to this commentary. Overall, the sector is giving a view that clients are still more focused on cost optimization, vendor consolidation, and the focus is on cost efficiencies, on automation with a result-oriented approach. But discretionary spending is still continues to be on the lower side, and it is showing signs of pickup nonetheless. So, slight green shoots of recovery is what we can conclude.
So slight green shoots, but let me come to you specifically, Nirav, on LTTS and Mphasis. Both numbers out after market close yesterday, and we'll see the reactions today. How would you rate them, and would there be a buy on them, a sell or a hold?
I think at this point of time, if these stocks are there in the portfolio, then I think they are a hold. Because it's going to be quite some time away before we really see a meaningful uptick in the valuations, but wouldn't want to buy at this point of time.
So it's a hold, not a buy.
It's a hold, not a buy.
Okay. Let me come to Axis Bank. And we spoke in some detail about what is expected out of Axis Bank today. Axis, Mphasis, Wipro, all three of them will declare today. What would be your position on these three?
So with respect to Axis also, I think we would be cautious. We wouldn't want to buy into the stock. We are expecting some kind of pressure as far as the operating margins are concerned. The focus will be on the net interest margin, whether they are able to hold on to the 4% margin, and the asset quality. The asset quality, the quality of the standard assets, substandard assets will be very, very important going forward. In the banking space, I think we would rather go with ICICI Bank and State Bank of India.
We also have with us Shrikant Chauhan of Kotak Securities joining in. Shrikant, good morning. Thanks for joining in. Shrikant, the Nifty seems to be stuck in the range, right? 24,900 on the downside, 25,200 on the upside. This morning, I think a start around 25,000 is what we should be getting. Would you think a long trade for the next couple of days with the 25,200 target could be executed?
Yeah, good morning, everyone. I think, Nifty is finding a lot of difficulties to sustain at higher levels. But at the same time, if we go through with the last few days formation, then supports have also shifted to the levels of 24,800. So yes, what you're saying is right. It is stuck in the range, and as the momentum is missing from almost all the sectors, like Bank Nifty was also very close to the breakout level of 52,000, but from there all the way again it returned back to the lowest levels. I mean to say it closed at the lowest point of the day. So while looking at the setup of the market and the broader formation of the market, I am of the view that the market is going to spend some more time in the range until the market is not crossing any specific resistance or support. I think we are going to see such type of trend. Even if we go through with global markets, Asian markets especially, then there also we are seeing a lot of range-bound sort of activity at the lowest point of the fall. And maybe that's the reason we are following to the same. But I am of the view that today, if we see any reversal activity after hitting the levels of 24,850 or 800, then we could see some buying interest in the market. Otherwise, I think we need to be more and more stock specific.
Yeah. Talking about being stock specific, Shrikant, let's hear your picks for the day.
Yeah, Tamanna. I think Hero Motors, there we are seeing a consistent weakness. It is finding resistance whenever there is a rebound from lower levels. Currently, it is around 5,400 levels. From there, again, we are expecting one more downward move towards 5,250 or maybe even 5,200. We can keep stop loss at 5,450 for creating short positions on Hero Motors. The other stock on which we are bullish with a short-term view is Grasim. It is forming some reversal activity on a weekly and daily basis. which is positive. Currently, it is around 2750, 2770. But while looking at its technical formation, the next level to watch out for would be 2850, and in the best case scenario, 2900. So the medium term as well as long term trend for the stock is bullish. And as we are seeing activity in those stocks which are not part of the index, I think these stocks should do well if there is any momentum in the market. That's the view. We can keep stop loss around 2720 for the same.
Nirav, what did you make of Bajaj Auto's earnings? Most people seem to believe that it's been a solid quarter. They've had 20% plus margins for the last 4 quarters. Sales were looking okay. Bottom line's also improved. I think the only concern, maybe some of the larger brokerages had, that it's an expensive stock. But I mean, if you get that kind of premium growth, you pay a premium, I'd imagine, right? Do you feel like even at these levels, adding Bajaj Auto could be a good idea?
Yes, particularly taking into account the fact that auto sector has been facing some headwinds. I think Bajaj Auto's numbers look quite encouraging for the overall sector also. As you rightly pointed out, that you have to pay a premium for a premium performance. As you pointed out, 20% plus margins, but that's always been the case with Bajaj Auto. 21% margins, operating profit margins reported consistently over a period of time. That is one factor. That is the best in class performance. With respect to Bajaj Auto, I think yesterday's performance has also been quite good. And there are a lot of moving parts with respect to the valuation. One is the entry-level performance bikes, then the CNG motorcycles, the export performance, the commercial vehicles, etc. The premiumization aspect, which one needs to look into. So our take on Bajaj Auto is that we expect this superlative performance to continue for quite some time. And our near-term target for the stock is around 12,960.
Okay, Bajaj Auto, I just quickly want to take a view from Shrikant on Bajaj Auto. Since you talked about Hero, Shrikant, how are you looking at Bajaj Auto this morning?
Yeah, for Bajaj Auto, I think yes, the activity is again indicating us that it is consolidating. It is in the range. It is not crossing the level of 12,300. At the same time, it is finding support very close to its 50-day moving average, which is around 11,500. So I'm of the view that again, if there is any rebound because of any reason, then we should look for taking some profit on this particular stock, because I think gradually here also we are expecting some correction in the near term, and the stock can settle somewhere close to 11,000 in the near term. So I'm of the view that if there is any rally, look for reducing some long position.
Right, that's the call coming in on Bajaj Auto. While we are at it, actually, Nirav, you might be also suited to answer this. Last couple of days, we've been seeing some selling on the auto pack. Some argue that this could be because, auto funds or auto investors are probably selling a little bit of the M&M and Maruti in their portfolio and making allocations to the Hyundai subscription that's opened. What are your thoughts? Do you feel like there is a trade there, sell Maruti, buy Hyundai, or do nothing? I don't know what your thoughts are.
Definitely it makes sense to diversify the holdings. So cutting a bit of the position from the likes of Maruti and M&M and deploying it towards Hyundai definitely makes sense at this point of time.
Right. Shrikant, you want to come in? You talked about Maruti and Bajaj Auto. Anything else in the auto pack that you may be constructive on or may consider, shorting at this stage?
Yeah, I think, Hero looks weak, but if we consider a few other stocks, then in that space, I think Mahindra and Mahindra is trading and consolidating at the highest point of the rally, and it is relatively better than other stocks. So I'm of the view that in case if we see any correction because of the overall sectoral underperformance, then somewhere close to 2950, 2900 levels, we should look for adding Mahindra and Mahindra to our positional portfolio. I'm expecting stock to consolidate between 2950 and 3200, and later on we are expecting stock to do well and outperform relatively is doing well, so outperform other stocks. So yes, buying is advisable on dips for Mahindra and Mahindra, but for other stocks, we need to be a little bit careful.
For M&M is the only buy on dips call at this point. Very short break. We're right back with pre-open rates and what the big strategy for the day is. Stay tuned for that and more. Those Mphasis flashes on your screen, numbers largely in line, but I think what is important is the company highlighting in its con call right now about how they have bottomed out from the worst, and M&A activity definitely is back. Shrikant Chauhan and Nirav Ashar with us this morning talking about the trade for the day. Shrikant, let me start with you and let's talk specifically about Mphasis. Let's talk about Havells. Another one whose numbers will come. Mphasis, of course, is out right now. How are you looking at both of them on the charts?
Yeah. So if we see the technical pattern of Mphasis, then there we are seeing lower top, lower bottom sort of formation. So we can expect some more weakness in the near term. The stock can fall to the levels of maybe 2800 or 2750, where the stock is having support of 100 days as well as 200 days simple moving average. So I'm of the view that stay away from taking any long position on Mphasis BFL, and if there are any positions, then look for reducing that because we can expect some weakness in the near term. For Havells, there I'm of the view that it is like holding well above the consolidation zone of 1900 and 1700 on the downside. So while looking at the technical pattern, I think it is very close to the support levels, and here we can again expect rebound in the near term, maybe up to 2100 or 2150. So yes, it's a buy, but with a very tight stop loss at 1900 because the markets are volatile, and in case if we see any further more weakness in the market, then the stock can easily come down to the levels of maybe 1800. So at these levels, it's a buy, but with a stop loss at 1900 on the downside.
Okay. So Havells is a buy with a stop loss of 1900 on the downside. First rates are hitting, and we'll give it a minute to settle. Mphasis, Wipro both looking good in the first few seconds, so to speak. The Nifty seeing a bit of a pressure there, but you're seeing at least IT stocks rebound to some extent. I want to see Axis Bank just for a second. Let's look at what's happening with LTTS. Let's look at Mphasis. Some of the numbers that are going to be on radar. I also want to see what's happening with an RIL. Mphasis looking good, about 4% up. So those numbers definitely in line, and the commentary bolstering the street. RIL is the other important one, of course the bonus issue has been announced. Record date is October 28th. So 1:1 is the bonus issue. Let's talk about 0.75% up right now. Shrikant, RIL on the charts?
Yes, Reliance Industries is very close to its long-term support, and at this level, certainly we are expecting rebound in the stock. Traders as well as positional traders should look for taking contra bets at current levels. This stock can again move back to the levels of maybe 2850 or 2900. That's the overall view. It will take some time. It's not that we are going to see quick rebound, but yes, it is very close to its decent support levels, and we can keep stop loss around 2600 for taking positional trade on the stock. So it's a buy at current levels and more on dips.
Might be a bad day for banks. Early minutes yet, so not coming into any great conclusion, but look at an HDFC Bank this morning in the very initial period, and that's looking like it's going to have a bout of trouble. Obviously, all of that will settle. It's just 2 minutes into pre-open, so keep that in mind. Equitas, Small Finance Bank also looking like it's in for a rough ride. Sterling and Wilson, meanwhile, buzzing once again. CRISIL on the back of its numbers, buzzing once again. RVNL on order wins. So you're seeing all of those factors up and about this morning. But meanwhile, I think one big factor, just not for IT companies alone, but that the world is watching, is what's going to happen in the US elections. And guess who is talking about US elections for NDTV Profit? It's none other than veteran investor Ramesh Tamanna, because even as all attention is focused on the high stakes battle between Kamala Harris and Donald Trump, Ramesh Tamanna has spoken with American political scientist Larry Sabato on whether there is a hard glass ceiling to Trump's vote percentage. Take a look.
Larry, in 3 elections, in 2 elections in the past, Trump has never won the popular vote. Does the base mean that he gets a minimum, but there's also a hard glass ceiling to his vote percentage?
Yes, that's a good way to put it. He has a ceiling, I think, of 47, maybe you could stretch it to 48, but I don't see him ever getting over 50%. I just don't think it's possible because he has too many built-in opponents, and he reinforces those opponents almost every time he gives a rally. He says something outrageous or 10 things that are outrageous. However, his base will turn out in large numbers. So the burden is placed on the shoulders of the Democrats. They have to get their base, which often finds excuses for not voting, to turn out at the same rate. If they do, they'll at least win the popular vote. The Electoral College vote is something completely different these days.
That's an interesting point, and I think my viewers in India will not understand that though this is a direct election between Kamala Harris and Donald Trump, the winner of the popular vote doesn't win the election. The winner of the electoral vote wins the election. What is the electoral vote? Can you just explain it to us, to ordinary viewer here?
Yes, I won't go into too much detail except to say when the founders of the United States established the Electoral College back in 1789, there was no popular vote. We didn't have elections except through the Electoral College. Now, who were they? They were the elites of each of the American states. And they didn't meet together, but they met in their respective state capitals, and they picked candidates that they felt were appropriate to the presidency and the vice presidency.
I think it was called the smoke-filled backrooms in the 1960s.
Yes. And they all smoked back in 1789. I think by the 1960s, some were catching on that smoking was bad for you. But nonetheless, it's not a system that works very well, but it will stay in place because in America, we're too divided to change anything. Seriously, we cannot pass a constitutional amendment to celebrate mothers.
That's true. But, the Benjamin Netanyahu said that. He says, I always lose in the elections in the polls, but then I win in the final election day. Is that fair to say about Trump also?
Well, he did lose in 2020, and of course he made up this giant story to cover his wounded ego about voter fraud. That's my field, and I'm here to tell you there was no voter fraud. He made it up. But of course his base believes anything he says, and so they still talk about the voter fraud. There was no voter fraud. So he did lose in 2020. He lost the popular vote as well in 2016, but he won the all-important Electoral College. Now, this time around, it is very close. I don't think he'll win the popular vote. I don't think he'll ever win the popular vote unless there are 10 candidates. But in this particular case, his problem is the Electoral College because his coalition isn't as strong as it once was, but it may be stronger than Kamala Harris's, which is all that matters.
Okay, so you can watch that full show ahead on NDTV Profit. And remember, we have you covered on US elections from the lens of none other than veteran investor Ramesh Tamanna. That's one show you just cannot miss. Meanwhile, let's get to the brokerage report of the day, even as pre-open rates have settled. And Mihika, this next one that you've picked for the brokerage report of the morning is a double whammy for SRF, isn't it?
Yeah, that's right, Tamanna. So UBS has double downgraded the stock from a buy rating previously to now a sell rating. They've also cut the target price to 2,100 rupees versus 2,700 rupees earlier, which implies a 8.8% downside to yesterday's close. Now, what UBS is saying that the market's expectation of a demand recovery in the chemical segment, which is 70% of the company's EBITDA, will disappoint. They expect the agrochem demand environment to remain difficult going forward, and they also expect a negative surprise and the market share shift to now move towards Chinese manufacturers. And because of these factors, they've cut the FY25 as well as FY26 EPS estimates by 20 and 22%. When you talk about what is impacting the agrochemical demand environment, one is continued deterioration of crop prices. Second one is soft feed demand outlook in China's hog industry. And the last one is data is suggesting that there is a possible risk of Brazil's agrochem imports, which are now entering a down cycle.
SRF already seeing the beat, I think 4% down in the pre-open session at least. Nirav, you concur with the basic premise of why this double downgrade, which is the pressure which intensifies in this space. Chemicals is still a tough space to be in with the China factor.
Agreed. Actually, in the case of SRF, we've had a few disappointing quarters, and SRF is into three divisions. One, they have technical textiles, the second is packaging films, and the third is specialty chemicals. Specialty chemicals has been a pain point for the company, especially the global scenario, the constraints with respect to the China demand, the excess capacity over there. That has been a pain point for the company. There was an expectation that the margins of the specialty chemical segment are expected to pick up from the second half of the current financial year, but that has not materialized. To make matters worse, in the case of packaging films also, we have been seeing some excess capacities being built up, being put up in the case of BOPP, BOPET films, etc. So I think all this has compounded, all these problems have compounded and have resulted in a valuation downgrade for SRF. So I think the near-term challenges are likely to persist, putting pressure on valuations.
Sorry. Okay, so SRF is an avoid this morning. Just look at a CAMS as well. Some of that real estate play is still continuing to some extent or maybe poised for it. Shrikant, I want your call on some of the stocks that we saw really firing, a Motilal Oswal, a Nuvama, a CAMS, for example, as well. Any of these that you still see interesting for a further upside, and anything you've spotted from the pre-open session?
Yeah, I think, most of these stocks are really doing well. There we are seeing buying momentum, and again, on a day-to-day basis or week-on-week basis, they are managing to surpass their previous highs. So while looking at the setup, yes, we can see some more buying attraction based on their strong momentum. But currently, they are far away from their recent lows. And it is advisable to buy if there is any correction instead of participating at higher levels. So it is better to stay away from taking any position at current levels. Let the stocks correct back to their important support levels to create any long positions. But for this thing, I'm going to say from the FNO basket and pre-open list of stocks, in that we are seeing some buying interest in Reliance as well as Sun Pharma and Wipro. I am of the view that Wipro should do well in the near term. Yes, today it is going to announce its number, but based on its technical formation, I think the stock is heading towards the levels of 600. So in case if there is any correction or if we see any specific reversal sort of activity, then we should look for adding Wipro to our portfolio. And we also like Reliance, on which we discussed. There we are expecting further more activity in the near term. It is very close to its decent support levels.
Wipro would be a buy at this point, Shrikant? Would you stick your neck out and say that?
Which one are you asking about?
Wipro.
Yeah. Wipro, yes. It looks at these levels to buy because it has been consolidating between the levels of 560 and 520, 530 on the downside. And again, it is available at 530, 35 levels. So certainly it's a buy with a stop loss. Little bigger, we have to keep a stop loss. We have to keep stop loss around 518, 515. And we can again expect 560 and 600 on the high side. So Wipro is certainly at these levels buy based on technical formation.
How does MCX look? In fact, let's talk about MCX and HCL Tech. Both of them are trading at the record highs, but there's been no significant or aggressive follow-up buying. Both those trades, anything there on the long side, you think?
See, I cannot talk on MCX because of the compliance issues, but if we consider the HCL Tech, then there we are seeing good amount of buying attraction and it is into all-time highs. It has broken consolidation range at 1800 and since then it is doing much better, relatively better than other stocks. So here we have a target of 2000, 2050 based on its technical formation. And even at this level, it's a buy. But yes, we need to see that whether the sectoral performance comes or not, because see, we are seeing some mixed activity in these markets. So it's a buy, but with a tight stop loss around 1820.
Look at how Bajaj Auto has reacted in the pre-open session. SRF, one of the top losers on the Nifty 500, but then so is Bajaj Auto, about 3.5% down. So I think those concerns about margins as well as average selling price seem to have hit the stock quite badly. TVS also following suit, actually, about 1% down. Nirav, is the sheen coming off two-wheelers right now?
Well, at least at this point of time, there's been a negative reaction, but I think we continue to like this space. And as we have pointed out, we would use this as an opportunity to add some positions, especially with respect to Bajaj Auto, because we maintain our price target of 12,960 in the medium term.
Right. So there are a whole bunch of auto that continues to be on the sell side. Day 3 and auto stocks are looking like they're under pressure. 25 seconds to go as we gear up for market open. It's going to be a lukewarmish day of trade. It'll be a tight range. There is a little bit of a handover that's positive from Asian markets, but now whether we get bought into is going to be something that we'll have to wait and track. But remember, 25,200 on the upside has proved to be serious resistance, at least for the last 1 week of trade. Bank Nifty took a little bit of a breather yesterday. Now whether you see follow-up buying today is going to be interesting. Counters like Axis also report numbers. Well, that's the street, and as expected, it is a gap up. Like we said, there would be that initial positive uptick, which very likely may get sold into as we go through the course of the day. Not being able to hold, that's a very, very clear sign coming on the Nifty 50, back below 25,000. Stabilizing, let's give it a few minutes before we come back to this. Bank Nifty also trading with marginal gains, but nothing much to write home about just yet. 51,900 becomes important, so watch that one for all practical purposes. On the IT pack, HCL Tech reported numbers that were good. Mid-cap IT earnings weren't too bad either. either. What also stands out and awaited is the Wipro bonus issue. So very close eye out on Wipro and Mphasis that will report numbers today. Broader markets are performing in line with the benchmarks. There's no serious outperformance coming in from any of the verticals of the market. Let's take a quick check of how metals are doing. The reason I want to pull this up is because all eyes are on the Chinese stimulus. Trade would be on the sidelines, I would imagine, but no, it's actually not doing too badly. 0.6% higher. The outperforming sector of the day in anticipation of a stimulus from China is got to be metals. Let's take a look at how the breadth of the market is, what the Nifty 50 stocks are getting up to. The bias seems to be slightly on the upside, but not significantly in that sense. Stock of the morning is L&T. Now, there is no apparent reason for L&T being your top gainer, but the counter looks okay in trade. 1.5% is what we have. Hindalco, like I said, so metals clearly working in anticipation of a big sort of impetus coming in from China, and that is helping a whole bunch of those metal names this morning. Hindalco is higher. ICICI Bank doesn't look good. Infi is also trading with a positive bias ahead of its numbers. RIL on back of that bonus issues giving some support to the market, up nearly 1%. Some of your pharma names are seeing a little bit of buying, but nothing sustainable or significant at this stage. On the sell side, Bajaj, look at that. I mean, this is one reason why the Nifty is struggling at 25,000. We know this is an expensive stock, but this is a great set of earnings that is getting hammered only because the stock is expensive. There's no other reason why you're seeing that kind of sell-off on Bajaj Auto, nearly 8% off, and this could be single-handedly pulling the Nifty lower. And it's not just that, right? Third straight day of auto losing. So from the day the Hyundai IPO opened for subscription, we have been seeing auto stock sell off, and today is day 3, which is also the last day of the Hyundai subscription as the IPO closes. But the top 4-5 losers are very clearly coming from the auto pack, and I'd be a little concerned about this. Day 2 and Trent continues to lose. It was down 5% yesterday, and there doesn't seem to be relief on the counter even this morning, so 1% lower. Shriram Finance, which is an auto financing company, also seeing some weakness. This is season and busy time for them, so you'd imagine that these stocks will be doing okay, but not really. BPCL also trading lower on back of a little bit of recovery on crude, but that seems to be more of a trading play, at least so far, what we've seen. Tamanna, I am just shocked and disappointed. I mean, this is beaten down more than anybody, right?
Yeah, hammering for Bajaj Auto. So, I mean, some of the notes that we referred to this morning did see troubles with their exports, troubles with their average selling price, maybe, and the fact that the 125cc segment is not doing as well as you would expect.
So, I think along with all that you mentioned, the fact that you've got this Hyundai IPO
could be
is also.
But then you'd expect a Maruti M&M.
Maruti and M&M did really badly yesterday. Bajaj Auto was flat. So the cumulative losses of these 4 stocks is about 5 to 10% in the last 3 days.
Yeah, and also I would say look at the Tata Group stocks. Trent down about 1.5%. Titan feeling the heat as well. Obviously, a lot of news around the Tata Sons board because of Noel Tata now becoming Tata Trust chairman. He's expected to also have a seat on the board. And I don't know why, but there is a fair bit of pressure on Tata stocks as well. Bajaj Auto, though, the story this morning, frankly, and can't take your eyes off that. But let's look at the broader markets as well and look at what's happening across sectors. Mid-cap 150 in the red. I mean, flat to negative. That's really the move. Nothing much moving right now in the market. Is this the liquidity squeeze that we are seeing? Is this uncertainty because of earnings? I mean, the reaction to some of those earnings is virulent, to say the least. Nifty Auto there, obviously dragged down by all the majors, getting completely dumped. Nifty Realty feeling the heat as well. Consumer durables, FMCG, remember Nestle numbers will be out later today, all feeling the heat. What's working? Nifty IT barely so. It's Mphasis and Wipro which is sort of keeping the flag flying. Nifty Metal not so much. All right, let's look at specific stocks, and let's start with result impact because that's where it all is. Mphasis, LTTS, CRISIL, Colte Patil, 4 of them if we can pick up. LTTS not looking good. Mphasis, decent set of numbers, in line at least 3% up, but LTTS feeling the pressure, about 2% down. Colte Patil has done very well, 8% up, at least, one very, very positive stock of the morning, now climbing 9% up on the back of its numbers. CRISIL also, fabulous numbers that has worked for it. So where the numbers have been good, Street is rewarding, but it's an aggressive reaction on either side. RVNL has order wins, and some of that impact is seeing 2.5% up on RVNL. Bikaji, we're speaking to the management later today. They have an acquisition in place. Not too much excitement on that, to be honest. They're acquiring Hazelnut Foods. SRF, I want to see what happened there. Double downgrade from UBS, 2% down. Not as bad as the Bajaj Auto today, but yeah, SRF also hurting. APM gas has been reduced by 20%. That's what city gas distributors will go. Mixed bag for IGL and MGL. Not too much of an impact there. Sterling Wilson is the other one that I want to pick up. Its buzz has been continuing. The winning run continues this morning in trade as well, so about 3% up. But I would say, Samina, in terms of the broader markets, CRISIL, Kolte Patil are the clear winners, and Bajaj Auto really hitting a speed breaker.
Not just Bajaj, Tamanna, TVS, Hero are all trading with big cuts. So 4.5% to 5% off on TVS. You've got a similar cut that's happening on your other two-wheeler company as well. So across the board, two-wheelers are bearing the brunt of maybe what Bajaj Auto reported, maybe the fact that a lot of the reallocation or rebalancing is taking place in the auto funds on back of a huge listing that is lined up. So auto as a pack is looking weak, third straight day running. On the gaining side, there are a few stocks that are looking good. So we've already mentioned for you how CRISIL reported numbers that weren't too bad. Rail Vikas bagged an order. It was Railtel yesterday, but Rail Vikas today. But the whole railway stocks pack is actually looking quite good. So from your Rail Vikas Nigam to Rise to Titaghar are trading with pretty decent gains of about 2 to 2.5% each. A few smaller stocks that I want to quickly highlight for you that may be seeing some movement on earnings is Aditya Birla Money and Pondi Oxide. If we can get both those counters up, let's see if the markets are rewarding these counters. AB Money is flat. Pondi Oxide, which reported phenomenal numbers, is at upper circuit. 5% on Pondi Oxides on back of very, very solid numbers being posted by this company. Stock is a big expensive one, like you can tell, but it's 11,000 crore market cap. Good numbers. Stock gets a thumbs up 5%. The other one worth mentioning is Cochin Shipyard as it exercises its green show option of another 2.5% stake sale by the government. The stock is coming under pressure on back of that, trading with a cut of 2%. Take a look at LTTS and Mphasis. Both reported earnings. In my view, they were both largely in line with what the street was expecting. LTT gets thumbs down. Mphasis trades marginally higher. 3.5% on Mphasis. L&T Tech trades the cut of 3%. Axis Bank was slightly nervous ahead of numbers, down 0.6%. So that's really what the theme of the morning is. It's all about earnings, and the markets are doing that. Sectorally, one sector that's doing a little bit of a standout or reversal after many, many days of weakness is pharma. So your pharma counters aren't looking too bad in early minutes of trade, and so is metals, giving the markets a little bit of support this morning. But apart from that, the rest of the market going into a little bit of a zone and seeing some cuts as we speak. But Shrikant, in the first few minutes, have you identified a trade for the day?
Yeah, I think like all these two-wheelers are really showing a lot of weakness. Most of these stocks have broken their important support levels, especially if we see the technical pattern of Bajaj Auto. It has broken its important level at 1100. So there we are expecting further more weakness. But TVS Motors, here we saw some specific bearishness. It is very close to its breakdown level of 2750. I'm going to say it is trading below the same. So the next level to watch out for would be 2600 and maybe even 2500, where the stock is having support of 100-day simple moving average. So we should look for creating some short position on TVS Motors around 2675, 2700 levels with the stop loss close to 2750, and we can keep target somewhere close to 2600 or 2500 on the downside. Surprisingly, State Bank of India is doing well, and it is trading above last 20-25 days of trading range. So there we can see some activity, but to be very specific, we need some more sustenance for this particular stock above the levels of 810. Then only we can see the levels of maybe 850 or 855. But at this level, I think it is better to be more on the sideline, because the markets are at crucial levels, and unless until there is any specific reversal formation or breakdown formation, I think we need to be a little bit careful while taking any trade.
Okay, SBI up Nalco. Let's just pull up Nalco. Aluminum prices have surged some 45% this year, and strong aluminum prices is what has Nalco bumping up today in trade. 4% up. Now, this is a problem which has continued, and Alcoa Corp In fact, of course, listed in the US markets, jumped 10% because of the strong aluminum prices. Nirav, just want to get your take on the whole aluminum belt. Let's look at Hindalco, Nalco as well, and whether you think that this commodity squeeze is something that you would buy into.
Yes, definitely, because we've seen the certain commodities like copper, which have rebounded in the recent past, and aluminium also seems to be following that trend. And in line with that, we have seen Hindalco move up in trade, and of course, we are seeing Nalco also inch up in trade. Another important factor is that the backward integration initiatives of these companies are going to be helpful to them, and the Chinese stimulus expectation also is playing its part. So I think all these factors have contributed to a rally in these stocks.
Okay, that's a rally coming in there. Shrikant, on any views on a Nalco?
Yeah, there we have a bullish view, and technically it is indicating us that it is heading for at least 250 in next few days. It will take some time because currently the stock is into ban period of FNO. But while looking at its technical pattern, I think gradually the stock is heading higher, and we should be buyer with a positional view. With a very short-term view, I think the stock can remain in a range of maybe 235 and maybe 215 on the downside. So it's a bigger range. But broadly, the stock is showing a lot of momentum. Even Hindalco also, it is comfortably holding above the levels of 700, which is positive. And based on its technical formation, I think in the long run, we can even see the levels of 1,000 plus on the stock. So I am bullish on Hindalco as well as Nalco, but with a very short-term view, we need to be a little bit careful in this market.
Nirav, metals are looking up this morning, but do you feel like it's just sectoral rotation, or maybe there's good reason to buy given that we're all anticipating and awaiting this Chinese stimulus? How do you feel about this sector? I mean, it has its days. Today seems to be one of those.
There is always an expectation that something better will come up, and I think that is the hope rally which we are likely to see, especially in metals. But there's one sector which we have missed out. I think that is telecom. I think the recent telecom congress, which we have witnessed, very strong cues as far as the telecom sector is concerned. So I think we remain bullish, very bullish about the prospects of Bharti Airtel as well as Reliance Industries. So this is one aspect which should not be neglected.
Okay, we'll wrap it there. Bajaj Auto stock of the morning, not for the right reasons. TVS following suit, as is Hero. Auto Pack under pressure, and how? On the upside, CRISIL is doing well this morning. RVNL also firing because of order wins. CRISIL because of their results. All right, thank you so much, Nirav and Shrikant, for joining us. Let's turn our attention to a company that is in the news for its acquisition spree. This time they've acquired Hazelnut Factory Food Products, which has 6 outlets in Lucknow. Now, why does Bikaji Foods want to get into the QSR space in such a big way? Rishabh Jain, CFO, is joining us for more on that. Mr. Jain, a very good morning to you, and thank you for speaking with us here at NDTV Profit. Let's begin with exactly that point. Why are you interested in this company, in Hazelnut Factory Foods, and how do you think it adds value to you? What does it do for your financials?
Yeah, thank you very much for taking this time for us here. So basically, this Hazelnut Factory is very beautifully placed in the segment like patisserie, bakery segment, patisserie, artisanal sweets. So their majority of revenue comes from these 3 categories, including cafe and everything. So they've done a very good business. Like in this year, they'll be doing close to 60 crore plus revenue, and with a profitable growth. And we see a great growth in this bakery segment, this patisserie and artisanal sweet segment. So it will be part of our overall strategy of making a house of brand strategy in QSR segment. That's what we also created Bikaji Food Retail Limited 2 months back to foray into a QSR vertical in a reasonably big way.
Rishabh, interesting. So this is the plan, right? You diversify your offering, you go into different verticals. It's come at a good price. 131 crores is, I believe, what you're looking to spend to acquire this company. How are you funding this acquisition to begin with?
So regarding acquisition price, so basically currently in first phase, so we'll invest in three phase. Basically, this is the first phase, and we'll invest close to 61 crore rupees, a mix of primary and secondary, at the pre-money valuation of 100 crore rupees, which is 1.7, 1.8x of FY25 revenue. And if you see EBITDA, it will 10-11% EBITDA, so it's 14-15x of EBITDA. So it's largely fair deal for both the brand, for Bikaji as well as the hazelnut. And it's a win-win situation for both of us. And in 3 years, we'll fund the same next 24 months. So it's largely from internal accrual.
Through internal accruals, Rishabh, did I catch that? The 61 crores that they're going to be paying upfront, will that be coming from accruals or would you look at debt?
No, it will be from internal accrual. So we have done major complete capex expansion last year. So we done expansion. So we invested close to 440-450 crore rupees in last 3 years in capex expansion. Currently, we are at close to 45-46% utilization. So for next 3-4 years, we doesn't need major fund to grow this business, packaged food business. So this business will fund majorly through our internal accrual.
Mr. Jain, just trying to understand, this is your second acquisition, right? Earlier was Ariba, which is frozen foods.
Right.
I'm not too clear about what the play here is. Why do you want to go into these segments? QSR segment is a tough space. You have a hold and a brand recognition in ethnic foods. Why the foray? What are you expecting to achieve out of this?
Right. So basically, we are anyhow into QSR. Like we have an outlet in Bombay, which is doing fairly good business for us in QSR segment. And so we want to establish this business. And it's a big category for us. And we understand this category well. We understand food, we understand operation. So that's how we want to foray into Bikaji, this QSR business. So Bikaji also will build our snacks business. So like Haldiram's of the world. So we'll build our QSR business in Bikaji Foods. But yeah, to expand our patisserie, bakery, artisanal sweets, we want different brand, and that's how we entered into this acquisition.
Can you tell me what is the revenue of this acquisition that you made? And while I know it's great because I think you're trying to offer, diversify beyond just what your USP is, and maybe a good idea to do so at a strategic level. But what is the top line of this business that you've acquired, and what are the margins that you enjoy, and what will blended margins be even 1 quarter out? Because I'm guessing it's a plug and play, right? You literally acquire it and the business starts contributing to your top line and bottom line.
Right. So basically, this business within FY25, this will do close to 60-65 crore of top line with a EBITDA of 10-11%. So it's a fairly profitable business for us.
Your current top line, Rishabh?
So FY24 it is close to 45. FY25 will do close to 60-65 crore rupees.
So it's going to be 65 plus another 65 crores. That'll be for the year. So it's over 4 quarters.
65 for the year, FY25.
So another 25 odd crores in the next quarter can be expected on back of this acquisition onto your top line, Rishabh. Is that fair?
So basically, currently we're acquiring 40% of the stake. So this will this will not become a subsidiary as of now, but yeah, in next 24 months it will become a subsidiary.
What is the impact on your blended margins, Rishabh, that you expect after these acquisitions?
So the margin of this company is also 11-12%. So it will have same impact. So currently we are also having 14%. So it will be same impact. It's doing same margin, what we are doing as of now.
I assume, Rishabh, you would not be content with just having a local presence in Lucknow. One way to do this is, of course, either you go out and buy some more similar businesses in other countries, or you expand this. What are the plans you want to tell us? And also, where do you see that 2 years out, right, in terms of top line compounded?
So we see in next 3 years, this business can do a 200 crore business for us in next 3 years. That's the potential of this. And we'll majorly grow this THF in North Indian space, North India, the UP and NCR area. That's a major focus area for next 2-3 years.
Okay. Any more acquisitions on the cards, Rishabh?
Nothing as of now. So majorly focusing on QSR as our packaged food business. That's the core for us.
Okay, so QSR is the next step, and you're right, there is QSR on Bikaji as well, ethnic foods. I don't know, maybe a patisserie is a different kind of a business to run, but yes, if you have it down pat, why not? Thank you so much, Rishabh Jain, CFO of Bikaji Foods International, there speaking with us. this morning on their acquisition of Hazelnut. So that's the big one that we're tracking. But meanwhile, let's talk about the big story this morning, which is definitely Bajaj Auto, 8% down. Let's pull up some of those brokerages and what they have been saying about Bajaj Auto and why we are seeing this kind of a pain coming in. So MK earlier in the day on Bajaj Auto had decided to downgrade it to a sell from reduce with a target price of 9,500 versus 8,300 earlier, downside of 18%. Now, some of the reasons that MK said this is because Q2 results were marginally weak on lower ASPs, that's average selling price. Two-wheeler retail growth has been muted in FY25 year to date at 6.7% and September to October at 5.7%. That was also one of the reasons that they were concerned. Market share loss in the fast-growing 125cc category is the concern. Remember, there's more competition which has come in here from peers for Bajaj Auto. Management is expecting FY25 industry growth to be closer to 5% than 8%. This is what has, I think, hurt sentiments, that the outlook for the year and industry growth is 5% rather than 8%. So a bit of a downgrade there. Due to ongoing below par festive performance persisting, that's a pain. Exports are recovering, although with key Nigeria market still 50% below its earlier peak. Elevated base effect for the three-wheelers may also kick in. Estimates are unchanged at 13% EPS CAGR for FY24 to 27. At least MK says they prefer Hero on better risk reward and TVS on improved growth prospects. Jefferies, meanwhile, on Bajaj Auto says they've retained a buy with target price of 13,400 versus an earlier one of 11,630. So Jefferies is actually fairly sanguine on Bajaj Auto. They say the strong growth, but a slight miss in Q2. Gross margins have contracted 130 basis point Q-on-Q on higher share of lower margins in electric two-wheelers. Company is expecting 3 to 5% growth in motorcycles in the festive season and remains more optimistic as registration data suggests a 12% year-on-year growth in two-wheelers. Optimistic on continued Q-on-Q improvement in exports, and the electric two-wheeler share has risen from 11% to 21% in September. So electric two-wheelers are growing, but is it at the cost of the higher margin products is, I think, one question that we're seeing on Bajaj Auto.
The top 6 losers are auto and auto financing companies. So you've got Bajaj, Hero, Eicher, M&M, Maruti and Shriram Finance. The top 6 of the Nifty 50 is deep in the red, and it's only coming in from auto and auto financing companies. The Nifty is sub 24,900. Now, I think this is when we start getting a little worried. This comes in despite the fact that global cues are positive. You are seeing pressure on the index, and 24,900 was being respected at least up until this morning. I'm not sure what's gone wrong, but there is weakness, and if this persists and continues, we may be heading all the way down to 24,700. So the hope is that the bulls will make an attempt to fight this out, and we will see a recovery in the next couple of minutes or the next few hours. But for now, it's not looking good. Bank Nifty as well, which was seeing some outperformance, has called it quits from the look of it, with HDFC Axis leading the losses on the way up there. You've also got consumption that's weak. Metals like Tata Steel aren't looking great. So all in all, it's a tough morning. Or the only gainer on the buy side is Infi. SBI is doing okay because it's had so many days of underperformance, right? So 812 on SBI is what you have. Dr. Reddy's is holding out. TCS is fine. And TCPL is also not looking too bad. But it's literally a handful of gainers where the count very clearly is in favor of the losers. You've got 40 of the 50 Nifty counters that are trading weak. On the Nifty 500, the picture is no different. While you have Bajaj that's leading the way down, KEI Industries, remember they reported numbers. The numbers were not great, but brokerages have, I think, sort of come out with reports that has dented the outlook on KEI. So the counter is seeing a 5% cut as we see it. Real estate also is not looking good. And on the winning side, some of your rail counters are doing okay. And you've got small gains that are taking in for the likes of a Chennai Petroleum.
Okay, absolutely. All right, results in focus. L&T Technology Services is the other one we're looking at, and Amit Chadda joining us now. He's MD and CEO at L&T Technology Services. Mr. Chadda, a very good morning. And thank you so much for speaking to us. Great to have you on. Let's start. Your Q-on-Q top-line growth is strong. What do you see as the key factors leading to it, and how predictable is this kind of growth over the midterm?
The top-line growth that we've had about 4%, Q-on-Q in dollar terms is driven by sustainability segment firing for us, which we had said will continue to start going upward. We had a lot of work going on in plant engineering, and then industrial also has done well this quarter and should do well next quarter as well. So we're seeing that upward momentum. The interest rates coming down is helping that segment and will continue to help that segment. Second, what's happening is the aging workforce is a reality, and we are seeing a lot more automation work coming out on the shop floor and in products area as well as the plant area for this segment, and that is helping. And we, as being, shall I say, having those differentiated offerings, are able to make a mark and impact. So you will see sustainability continue to do well as you go forward next few quarters. Knock on wood, fairly comfortable. Tech is starting to spend again, Neeraj. So tech is spending other than most of the Semcon. Let's just put it this way: most Semcon customers are spending in AI, Gen AI, compute power chips, and we are getting a positive impact from that. Number two, we continue to see positive impact from hyperscalers as they continue to invest in newer technologies and devices. And a couple of wins we have had this quarter in that area, so there is a ramp up that's there. Comms and media is the one that's been a little static. We'll see how it does. We've got some differentiated offerings. We believe that we will take them along. In fact, there's some Gen AI offerings in comms and media that we believe will help us in terms of gaining more market share as we go forward in next quarter. Now, when it comes to medtech, continues to expand and continues to do well. In fact, it was flat for us for a very long time, if you remember, but I'm happy to share it's grown this quarter. We're seeing positive momentum next quarter onwards, given trends of Quora and digital health. Now, and the differentiated offerings again that we've got. Finally, let's come to mobility. Mobility OEMs continue to spend. It's the tier ones that seem to be pausing spends, etc. Now, the key is that there's a number of consolidation deals that are playing out right now. We've been on the positive side of some of these deals in the last quarter. We expect to be on the positive side of these deals in the next quarter as well. And that gives us the confidence that there could be seasonality effects in Q2, Q3 for mobility, but quarter four, it will come back up and go on from there. I'm not saying that I've given up yet. I haven't. The quarter has just started. The second half has just started. A lot to be done.
Mr. Chadha, you mentioned technology is picking up, but when we see the numbers, it does show very low growth. Could you elaborate on what you mean when you say technology is picking up?
We're seeing new projects being signed. We are seeing new areas that they're giving out, farming out to people like us. Core contextual conversations happening, a lot more work coming. See, if you remember, sustainability didn't do well last quarter, and I told you I do see sustainability coming back. Yeah. Right. 3 quarters ago, mobility didn't do well, and I said mobility is going to come back in quarter one. So we've got some of that forward indicators in terms of backlog, etc. that we carry, and it gives us the confidence that this is back and this is where it will go. Plus, the investments that we have made are starting to pay off.
What's happening in mobility? All companies were saying that car companies are on a multi-year run to digitize, and therefore the spends won't stop. Has that reversed? Why is this space looking patchy?
See, there's two parts to it, right? Number one is that there are spends that are happening for future model years 27, 28 that continue to happen. Having said that, the adoption of hybridization as well as the EV is kind of in a limbo right now because, there could be relaxation in terms of till when do the ICE engines have to be, completely phased out? That could change. And if that changes, you get a little longer to do it. So you don't need to spend all that money immediately. You could do it in a bit, right? Second, SDV spends are varied because different OEMs are in different phases along with their customers of how much or what to roll out. So one of them, like for example, driver assist, passenger assist is now vanilla, it's across, right? But Gen AI based driver experience apps that are coming up now and trying to actually make your car an entertainment center for the passengers is different by OEM, and it's different by what an OEM can sell into their consumers, right? So a lot of that varies, if you ask me. Plus, charging infrastructure still has to catch up. And then there's new technologies around hybrid. There are people talking about fuel extenders now. So instead of ICE with a hybrid, you have EV with a range extender, right? Flip it around. And that's a very different concept. So some of this will continue to happen. I would not be too worried because it's not like this is going to happen like, for about 2 years, there'll be a down cycle. I don't think so.
You've also mentioned in your release that you're seeing an uptick in AI-led deal conversions. Now, have you shown those deal wins plus empanelment agreements in sustainability? Talk to us about those. What is the quantum that you're seeing?
Gen AI is coming to age where people are actually using Gen AI to look at real life use cases and see how that will impact. That includes software defined lifecycle around code reviews and tests. That includes manufacturing shop floor in terms of recognizing material and bill of material. It goes to material testing and the likes, and then leveraging Gen AI and AI to predict as to what would happen, looking at chemical equations. So there's a lot more applicability and projects that we are seeing applicability of in this. So for all, at one point, all of us peer group companies used to say we do 65% in digital, 50% in digital, etc. And beyond a certain point, we actually stopped saying digital revenues because everything was digital. So Gen AI will reach that stage that they will have components of that in each and every program, and therefore it will become part of whatever you are dishing out, delivering to clients, and therefore or executing for clients, and it'll just become the norm. And some of those investments we've had to make in Q1 and Q2 to safeguard ourselves. In fact, our long-term ambition is now building $3 billion segments, mobility and sustainability tech. Medium-term outlook, $2 billion, 17 to 18% EBIT, and then current is 8 to 10% growth with 16% levels of EBIT margins. So the point I'm making is that this technology disruption that's happening is actually fueling some of this that ambition that we've got. So it's not without support of spend patterns that we're making this statement.
So you have shown deal wins plus 2 empanelment agreements in sustainability. Is that right?
What's happening in sustainability is that a lot of our clients may not give us a big deal, but they'll say we are empaneling you to work on the following refinery sites, or we are wanting you to work on plant engineering across all our refining sites or our upstream sites. So it's more enabling us to do it, and then we grow organically, like we had signed BP empanelment last year, if you remember, and we go on. Then somebody said, give me a size of the deal. I can't give you a size of the deal because we are working together to define some of the areas we'll work in. So that's why I have confidence some of these empanelments have worked out. If you remember, we had signed a $100 million deal in plant engineering about 3 years ago, and somebody had asked me, after the 100 million, what will happen? Well, I'm happy to share that the client we signed that with is becoming one of our top 5 clients today. So a lot of this is organic growth that continues to happen.
Last question, sir. EBIT margins are lowest in the last 12 odd quarters. That's hurt the stock a bit this morning as well. What led to that?
So the guidance is that the EBIT margins will improve from here. There were one-time investments, there were one-time costs that we had in H1 that we had to take to be able to reboot the company and take it forward. If you remember, during COVID, we had done the same. So the COVID year was lower than this. So COVID happened, and after that, you saw improvement happening. We went up right up to 18.9%. Nothing in operating mechanism has changed. If you actually look at Q1 to Q2, the general gross margins have been flat. It's the SG&A that you see that is increased. So I have full confidence that as I move forward into Q3, the margins will improve, and beyond that to Q4. And then therefore, my exit rate will help me.
Okay. All right. Thank you for that. We seem to have lost the line there. Thank you so much. That was the management of L&T Tech talking about their quarter. The stock has recovered a bit actually from its worst point of the day, but still about 2% lower on L&T Tech. But keeping up with the earnings conversation and the focus on IT, we're looking at Mphasis now. Revenue and profit beat estimates, and margins have seen a slight expansion. My colleague Samina caught up with the management who talks about the quarter gone by. Listen in.
The short answer is definitely the peaking of the cycle was visible for the last, I would say, 3 quarters or so. We actually called for bottoming in our banking and our mortgage business back in December timeframe. It's been a slow but certain recovery from there onwards. We've seen definitely a slight uptick in budget conversations, in spend conversations, in actual deal making. Short burst duration deals picked up earlier in the year. We've seen some of that play out in this quarter as well. Conversion from sold business, the order book, into revenue has also actually improved a little bit more this quarter, as it has been over the last 2 or 3 quarters. So from that perspective, definitely the direction of travel has been, in the right sense. But the pace is still a little bit uncertain because, as I was mentioning to you, there is a lot happening in the macro and the geopolitical world. And until we get clarity on a few more variables, I think we'll continue to see caution in committing to large programs. And if that wasn't enough, there's obviously a lot of excitement and confusion around what AI means to enterprises and how best they can adopt it. And that also creates a little bit more of a elongation in the decision cycle. So I think it's been a very execution-oriented quarter for us. We've just been very focused on executing to order book, executing to individual client needs, priorities, propositions within verticals, within geographies. And from that perspective, pretty pleased with the outcome of the quarter.
Nitin, your deal pipeline has been at a record high now for quite some time, right? Engagements have also been signed. But I think one thing is putting pen to paper and the other is actually that converting it to revenue. Are you seeing an uptick on this in the quarter that's gone by? And we usually like to talk about an outlook over a 12-month period, but because things are changing so swiftly on one hand and predicting things is so much tougher, let's talk about what happened in the last 3 months and what are you seeing going ahead? An uptick in conversion is visible, or is that still very slow?
So I think if you look at the way the funnel gets built, you obviously have opportunities that turn into deals in the pipeline. Then you convert that pipeline into TCV by actually signing some deals and committing clients to a program. And then from that point on, you start converting the TCV into revenue by actually executing on the programs. I think the pace of deal making, or at least origination of deals, has been pretty robust last few quarters. Same case in Q2. Conversion from pipeline to TCV, I would say still a little bit stressed because clients are still cautious in committing to large programs. But they are definitely looking at executing programs that give them immediate ROI. So there is an uptick in small deal volume. There's an uptick in immediate conversion. I need to get this program done in the next 6 months, and let's execute it. And then, of course, conversion from sold deals to revenue has actually definitely picked up. And that's why we've seen an uptick in revenue, especially in BFS coming through, which is mostly executing the deals that were sold in the previous few quarters. So again, in general, improvement, but conversion into actual commitment of deals still a little bit slower than we would like it to be. We've also seen another trend, especially in Q1, especially in, I would say, Q2, where there is an emergence of a category of deals where clients are now actually being curious about, can you infuse AI into my IT operation? And hence, can I see 30-40% cost takeout and productivity gain? And if that's the case, then I may have to look at how I spend the dollars and where the allocation of my budget will be for 2025. So early stages for that, but it's an interesting sign. We've been expecting for this to pick up. We call it an AI ops-led deal. I think those will actually open up the pipeline a lot more because there's certainty of outcome and ROI in those deals.
We'll talk about that in a minute, but you did allude to the fact that it's the small deals, it's the quick engagements, right? So one-off deals that come in where you spend some time, elevate the client if that's what they need, and you move on. Now, that is great, but it's not really sticky business in that sense, right? Would it be a fair sort of question for me to ask you to split this up on your deal pipeline, of course? What is the split? How much of it is coming in from long-term deals and engagements? And how much of your top line is coming from those one-off small engagements that you've undertaken? Arvind, you can take that one.
No, so I think, two elements to it, right? I think there is always a run rate of deals in in the, I would say broadly classify as maybe, 0 to 1 million or 1 to 5 million kind of pipeline. And that is typically much shorter cycle. And that's always kind of remained constant. I think a lot more volatility in the funnel happens when you look at large deals greater than 20 million. And that's where Nitin was alluding to in terms of their own cycles coming in. So it's difficult to kind of quantify in terms of what proportion comes in, but I don't think that proportion has changed too much, right? I think that run rate has largely remained what it has been historically. And the deltas in TCV wins happens due to, some of these large deals tends to make it a little more lumpy and volatile.
Right. Also, let's talk about, of course, we'll talk about AI and the geographies, but a few more, sense that I want to understand is, I know in July you talked about that you would be able to very comfortably manage margins above 15, and you've successfully done it. I think you've done 15.4, 15.6 in this quarter. How is that happening? Are these shorter tenure deals better margins? Is that why the margin profile has improved? Has the product mix changed? Are the clients that have come on board willing to pay more? Please explain this to me, Arvind, because in a tough environment, you only have that much bargaining power, I would imagine.
No, I would say, we've improved our margins by about 40 basis points to 15.4. We delivered 15% last quarter. They improved by 40 basis points. I would say about 20 basis points is due to Forex and 20 basis points is due to various operational efficiencies.
welcome. You're watching Talking Point. It's a difficult day on the street, and it's Bajaj Auto that's taken it to the chin. Earnings were in line with what the street was expecting. In fact, they were actually a good set of earnings reported by the company. But remember, the stock has ran up so significantly that it's pretty much seeing profit taking at current levels. Well, we do have Puneet who's standing by with more on those numbers and what brokerages think. Puneet, the numbers are good. I don't think we can find too much going wrong for the company or concerning at this stage. Of course, it is an expensive stock. It's ran up quite significantly. Some may argue it's expensive. Others may believe this is just healthy profit taking, right?
Well, definitely, and it's the results, as you said, were quite in line. They just had a one-time impact, but that was called out before the results itself. So definitely not too much wrong with the numbers. I think it's the commentary that might have gotten the street a bit disappointed, and that's why hence the stock reaction. So they have said that in commentary, motorcycle industry saw 1 to 2% growth during the festive season. Now, do know this is just the 10 to 12 days of the 9 days of Navratri and ongoing couple of days post that. So they've said that only 1 to 2% growth for the industry as a whole. They've also said that this has been falling short of the expectation of about a 5 to 6% growth that they had expected specifically from the festive period time frame. And I think this is the point which the street has taken to a disliking to specifically. Management is hopeful of a demand recovery in this festive season and in Q3 specifically as well. And they're expecting the festive season to end with roughly about a 3 to 5% year-on-year growth for this particular quarter. Now, apart from that, before I go to brokerages, there is that they had grown roughly 12% in the first half of the financial year, so from April to roughly about September. And they had mentioned that second half will be slower than the first half, but growth will be there. So expecting about a 10 to 11% growth is what the management has said. I think this is just a blip in festive season that is something that is a bit negative. Now, MK, they've downgraded the stock today. Target price 9,500 has been raised from 8,300 earlier, but is downgraded to a sell from a reduced rating. And they said that the Q2 was marginally weak on lower average selling prices of the motorcycle, and that also was affected because of gross margins. Market share has been lost in the 125cc segment. That's a key negative that MK highlighted. And they also mentioned that something like a Hero MotoCorp is much more preferable at 22 times price to earnings for FY26 versus 32 for Bajaj before the share price fall. And TVS as well as improved growth prospects. And Citi also had a slightly negative view. They have a target price of 7,800, much lower than the current market price. And this was also lower from 7,900. And the key thing that they mentioned was, they are a tad surprised with the festive demand outlook that the management has highlighted. And they noticed that the industry will only grow about 1 to 2%, which we spoke about. What's interesting is that the retail data, as per Vahan portal, has been 12% growth in the festive season. So it's essentially that the company has given lesser stock to the dealers, and more so the stock reaction is because of the expectation of high growth in the festive season. So it should, it'll be interesting of what happens in the festive season during the sales month. So by the end of this month, it'll be interesting to see what the sales outlook and the numbers come in. But overall, I think it's the expectation that is causing the stock price to fall, at least in today's trades. And as you rightly said, more than 100% growth in the last 1 year in terms of returns. Back to you.
Hi, thanks for that, Puneet. That is the Bajaj Auto story. The stock is down 10% and having a pretty significant impact on the index. It's not just Bajaj Auto, the whole auto pack, the top 6-7 losers coming from the auto sector and auto financing companies. So the pressure is obvious. We are in the midst of the festive season. Demand was expected to look good. We do understand that the sales are happening, but they're coming in at huge discounts. So we'll try and get better understanding of what is going on in the two-wheeler world later on through the day. But it's now time to move to Talking Point. Vikas Parshad, Portfolio Manager, M&G Investments, joins us from Singapore. Hi, Vikas. Thank you for taking the time out to talk to us this morning. Vikas, before we go into nitty-gritties, what are you feeling? The world is looking tough. I mean, on one hand, you've got those big elections lined up, not just in the US, but in most parts of the world. You have geopolitical stress, which is as real as it can get. We've been uncertain for quite some time now, but it seems like our valuations are playing catch up. China is coming out, but of course with stimulus packages they talk about, but we've seen no pen to paper just yet in that sense. How do you feel? Do you feel it's risk-off trade for the foreseeable future now, for at least Indian equity markets or emerging markets as a pack?
Hi, good morning. It's difficult to predict short-term movements. What I will say is that as a global investor, in a global context, Asia looks pretty good. China looks good, Japan looks good, and India looks good still also. Our time horizon is long enough that the short-term volatility is less impactful to our portfolios. Our positions are large enough that we don't trade in and out. There are days like today where you're seeing acute pain in one sector, the auto OEMs, and then also that's flowing into other areas as well, two-wheelers, the auto ancillaries. And so we took advantage of where some of these stocks opened this morning to add to our exposure. And what we did do heading into earnings season, because of what we thought were markets that were more resilient than perhaps they should have been, given geopolitical risks, we reduced the name count in the portfolio and we consolidated our holdings. So in the two-wheeler space, we now only own one of the names. Earlier in the year, we owned 3 of them. And so that portfolio management has been helpful so far.
Because, we keep complaining, and in fact, investors complain about India being an expensive market, and we've been expensive, a very expensive, high growth market from the time I can remember. Do you feel that after this recent correction Indian equity markets have witnessed, there is still some more room to go for us to become better priced? And if one needs to be an investor in this market, better days ahead if you're a buyer?
It depends. It's always bottom up. It's stock specific. What I would say is that the market is pricey, not expensive. The reason there's a distinction in our mind is that if something is pricey but not expensive, it's because that's where the growth is. So if you look at what a 1-year forward multiple is telling you, not so much. In the context of what that multiple becomes, then that is more important. You need to do your work. You need to be very specific, very selective. And that's what we feel like we do. The markets have done well. We have as well. And it's this approach that India is a market for long-term investors. You can't just own the entire market. There are opportunities for alpha if you do your homework. And you have to think long-term. So that works. We've been having this conversation for many years that India is very expensive. I've never really espoused that view. It's pricey, but not expensive. And the longer your time horizon, the less pricey India becomes.
So you're right. From a 10-year outlook, this is definitely not an expensive market, right? But tell me, with your India allocation, are you currently fully invested?
We have been for the past 2 years. The average cash balances that we've had, going back to the big short seller report that came out in Q1 last year, has been close to zero. We have been fully deployed. We continue to see opportunities. When we went through this portfolio exercise over the last 1 to 2 quarters of consolidating our holdings in what we thought were the winners in each sector, whether it's auto OEMs or hospitals or IT services, we did the same thing. We went through the same exercise. And we just redeployed the cash into our core holdings. We did not sit on any cash. But the trick for this year has been, even more so than last year, that there have been many ECM opportunities, equity capital markets opportunities, IPOs, blocks, QIPs, and we have participated in some. Most of them we have not. But we like our portfolio. So if we need to buy something or we want to buy something, then we need to sell something first. So that's what we've done. But we remain fully deployed even now.
Where is that deployment spread across? So you talked about a few sectors, but in that pecking order, tell me, where are your preferences? Where is the bias? Is it towards sectors such as IT and pharma, which are more global facing? Is it to metals, which has a little bit of a China play? Is it to domestic consumption? So it could be auto anchs, like you mentioned, consumer staples. How have you structured that portfolio of yours?
Well, the good thing about the portfolio is it's quite diverse. We own all of these. We are shareholders in auto OEMs, but over the last 2 years, that exposure has shifted from four-wheel passenger vehicles to CVs, and then this year there's more split between CVs and two-wheelers. If you look at healthcare, we have consolidated our pharma holdings, we have consolidated our hospital holdings, but we have exposure to those as well. There's no pattern when it comes to market cap. We're just looking at long-term prospective returns. So in the pharma sector, we have some exposure to companies that are sub $3 billion market cap, and then we own some that are much larger. Hospitals, we own the large hospital companies, but then also some of the small ones as well. So it's a pretty diverse portfolio. We own the metals companies, but again, we've been through this exercise of culling some of the smaller positions and concentrating our capital on what we think are leaders. What is a clear gap in the portfolio, but by design, is consumer staples. The first few days after the election results came out in June, there was a big rally in staples. We used that rally to reduce our exposure. We have more zero weights in that sector than in any other, and we've consolidated our holding. But it's still into consumer-facing names. It's just not consumer as is defined by the staples companies. So if you look at the air conditioning sector, for example, we are there. If you look at hotels, if you look at real estate, we are very much exposed to the Indian consumer, but more towards the high end now than before, and much less to the staples sector.
So does jewelry stocks, retail companies like a Trent, companies that do lifestyle, so Nykaa show up on your portfolio then at this stage? If it's not consumer staples, I'm guessing it's aspirational spending.
It is aspirational spending, and more on the retail side, less on some of the brands, some of the newer listings over the past 2 to 3 years. Those are fewer in the portfolio, though we are exposed to quick commerce and to food delivery already, and we like that exposure that we have. What we have consciously tried to add this year is exposure to the very high-end Indian consumer. There are some views on how sustainable this demand is. We think that it is sustainable. Something different has happened. What we originally thought was a K-shaped recovery coming out of COVID seems to have become a K-shaped economy. And there's clear acceleration at the high end, whether it's hotels or it's airlines. India's largest airline is adding business class, as an example. If you look at some of the more prominent properties, hotel properties around the world, the suites get booked before many of the lower category rooms. First time we're seeing that. You've seen the demand for large high-end homes in the NCR area. And we believe that will continue to other parts of the country as well. It is not exclusively a focus on the ultra high end, but that is more prominent in the portfolio than it had been. Also, we haven't spoken about PSUs yet. Our PSU exposure on the banking side today is lower than it was heading into the elections. And we had lowered our defense exposure also heading into the elections, but we've gradually started building that out in the recent weeks. The defense companies, I mean, not so much the banks.
Because you did mention that you've reduced your PSU banking exposure, and I'm assuming you've rebalanced that with adding a little more exposure to private sector banks. What about another space that's catching our attention for the last few months now is capital market sectors. So be it asset management companies, broking firms, platforms, there is so much excitement around these, right? Have you taken exposure, added positions to that space? Because if you're betting on the India that is getting financialized, this is a space you must be invested in, I'd imagine.
I agree with that. Asset management, we have exposure to. Some of the companies, it's basically a duopoly in the companies that provide services to the mutual fund industry. We have exposure there. Now, the wealth management firms, I admit that our exposure is lower than it probably should be. So we are continuing to do our work there. I presume that the next time we speak, the exposure that we have to that sector will be higher than it is today. And like with many sectors, we have seen re-ratings over the last 2 years. We have seen an earnings acceleration over the last 2 years. But all these stories are still pretty early on a sector-wide basis. And you don't need to own all of them. You just need 1 or 2 in your portfolio. So I agree with you. This is an area where investors should be spending more time.
And what about insurance, Vikas? Because if you're betting on a emerged India in some sense, insurance is a play that has enough and more room to go. Would you think insurance is a good sort of deal in India? And again, how would you play life versus non-life? Where is the bias?
So this is the same debate we had internally. And we, in the first half, in the second and third calendar quarters of this year, exited the life insurance sector. Our exposure is in the insurance sector is outside of that. So you framed it correctly, and that's the exercise we went through. And we decided not to have any life insurance exposure anymore. That could change over the next few quarters. We'll see how they trade. I would say that since we exited, that particular subsector of the financial market has traded better than I would have expected. But we'll see.
Because you're closer to the action in China than we are. What is going on there? You know, we've sporadically see good days and bad days on the LME with commodity prices moving. But it feels it almost feels like the Chinese government is propping up the bulls, right? Because every now and then they'll talk about releasing a stimulus, but we don't actually see that happening. Similar thing happened today. How do you play the metals back directly and also indirectly for an Indian investor who's got a home bias? Would it be a good time to buy into the metal story in India?
Again, you've anticipated something, or you've touched on something that we internally were talking about not very long ago. So when it comes to the Indian metal companies, and metal companies across the region and around the world, if an investor's new thesis is to buy because of what's happening in China, we think that there's a bridge too far to cross. they're not very related. The initiatives on the ground in China are directly to benefit the consumer in the short to intermediate term. It's not so much on the construction side or property side, on the metal side yet, we believe. That is our view. And so you asked earlier what's going on in China. A lot is going on in China, but we're not materially changing our China exposure because of any announcements over the past 2 to 3 weeks. We made a big allocation to China at the start of the year and in the middle of the year, and we continue to be positive on that market for both absolute and relative performance. So that's a separate conversation. We can talk more about China if you like. But when it comes to the Indian companies, again, we have consolidated our holdings into fewer and fewer companies in steel, in cement, in other metals and mining companies. And they are for India-specific, or at least non-China specific reasons.
Because how large is your stock portfolio? How many counters do you currently hold?
Well, this year the count is a little bit higher than normal because we've been participating in a lot of these IPOs. And as you know, most of them are quite competitive, even for the anchor round allocation. So we end up with some small allocations. What I would share is that the bulk of the risk is in the top 15 or so holdings, meaning that if you concentrate our active bets, more than half of that is in the top dozen to 15 or so bets that we have. And then we have some tier 2 players in the same sector, perhaps, or in some of the small and mid-cap space. Also, what I'll share is we have an allocation for small and mid-cap companies. It's the highest that it has been in the past 3 years, but it's not at the max levels. We've been steadily adding to it, again, being very selective. And we continue to find a lot of alpha-generating opportunities in the small and mid-cap space. Again, the longer your time horizon, the better the prospective returns you will find. But the amazing thing about India, the Indian market, is how it has changed over the past 2 decades. There are now 6,000 listed companies in India. You're approaching 2,000 companies with a market cap that exceeds $100 million US. Every sector is represented. Every niche is there. Even high-end, middle to high-end semiconductor manufacturing, it might not be there today, but in 5 to 10 years from now, it will be there. And the right companies are laying the groundwork, even for that kind of exposure. So it's a market that's evolving. If you look at the underperformance last year, this year's not done yet, but in 2023, 70% of the index outperformed. And you look at where the underperformance was concentrated, it was in the large mega cap names that once upon a time were the leaders of the market. That will happen again. Today's leaders won't be the leaders of 5 to 10 years from now. And we're investing in the India that is rising, in the forward India, the futuristic India. And we see a lot of opportunities all across the board.
Because the futuristic India has always got the debate of old economy versus new. And when we talk about new economy, while it's a great conversation, actionables are rather limited in terms of executing those trades or those stocks, right? Would you agree?
Well, yes and no. So if you look at some of the old economy companies, some of the most advanced and forward-thinking adoption of technology, broadly defined, is in the renewable space, is in the construction materials space. It's how software is being incorporated. It's how hardware, robotics, factory automation is being incorporated. Tracking of shipments is being incorporated. So you have some of these old economy stocks, like cement companies, like metals and mining companies, construction companies. But then you also have logistics, quick commerce, food delivery, at the forefront of technology adoption. So when we talk about the India of the future, we're talking about a lot of these sectors that are leapfrogging way stations along the way that someone might have expected. So for example, one of the best examples people talk about or have talked about in the past couple of decades has been the telecom sector. That most of India went from not having a landline to straight having a mobile phone. We're going to see that leapfrogging in other sectors as well. Quick commerce is a good example of that. We've gone from talking about a structured retail sector that is less than 10% and how that will play out on the organized retail side, looking at it through the lens that we view Western markets. But then now you look at the adoption of digital payments and quick commerce. That's another leapfrogging event that's taking place. And this is going to be very large, and we hope to be exposed to that sector for a long time.
Because you mentioned you've subscribed to quite a few of those IPOs that opened in India. And the returns of those are phenomenal. The subscription numbers are eye-catching. We have a significant big one that is open today. That's the Hyundai IPO, right? And I think it's somehow causing the other auto stocks to give up some gains because I'm assuming auto funds are rebalancing as we see it. Do you have a view on this one?
But directly on any specific IPO, I'll hold back from commenting. But I will say that we are probably nearing a peak level of activity when it comes to QIPs and large IPOs. But a deceleration won't be bad; it'll be healthy. But when you have multiple multi-billion-dollar IPOs and blocks coming through in a very short period of time, that does absorb a lot of the liquidity. What has been impressive to me is how much liquidity there actually is, and how much continues to come in every month from the domestic retail investor. So I think that will continue. The IPO activity will continue. But this has been a pretty frenetic pace that we've seen on the IPO front. Now, all these IPOs are very healthy. I'm not surprised that parent companies abroad, whether they are in South Korea or in Japan or in the northern part of Europe, are continuing to list their subsidiaries in India because of the valuation uplift that you get. But again, this is where the growth is. So we will expect to see those continue to grow.
You know, I agree. I mean, some of these IPOs are phenomenal, but there are others that may not be so great, right? I mean, some of those SME IPOs have been oversubscribed now, and there's not too much of a story going for them. And I know you can't comment on IPOs specifically, but one good thing they've done is they've ensured that there's some of the liquidity moves there, and that prevents some form of a bubble that our markets could have gone into. If you were to give me a percentage of IPOs that you've subscribed to recently, would you be able to do that?
It's low. It's low. We evaluate a lot of opportunities, and as you know, a lot of these companies, if not all of the companies, do come through Singapore. I get to meet them. It's heartening to hear their stories and where they've come from. But again, we like our portfolio. As I was saying earlier, if we want to buy something new, then we do need to sell something. We're not sitting on cash. We are fully deployed. So we have to be very selective. The hurdle for investing in an IPO is higher than it is even for companies that have been listed for a long time, because the information asymmetries are too high for us to be participating very frequently. But we are spoiled for choice. Small IPOs, large IPOs, mid-sized IPOs in the automotive sector, textile sector, hospitals. I met two companies just yesterday in the B2B sector and in the hospital sector. I have another couple lined up for today and tomorrow. So it's a very active market. It's good to be busy. It's better to be busy than not to be busy. It's good that these companies are looking to get some liquidity. What's also encouraging is that you're not seeing founders materially cash out. These are largely OFS type deals. There is primary capital, but it seems to be going for good purposes. And it seems to be functioning relatively well, the IPO market. SEBI's done a very good job of vetting IPOs and delaying IPOs if they're not satisfied. So we're getting very high quality options to choose among.
So for all that incremental money that's coming in, Vikas, are you adding to your existing portfolio of stocks? Or because with all these new ideas, are you getting greedy and sort of building the incremental cash flow with a different portfolio?
Well, I'd like to think that we are always long-term greedy, and India is a good market to be long-term greedy in. But we're because of the valuation uplift that we have seen over the past 2 years, and you see some of that, the impact of that today in the two-wheeler space, when you have earnings going up, but then a re-rating going up much more than that, stocks in the short term can be vulnerable to any surprises that are neutral to negative. And so for that reason, we have consolidated into fewer and fewer holdings. I believe we're largely done with that exercise. So incremental capital that will come in most likely does go into our core holdings, and we will save some for the IPOs along the way. As I mentioned earlier, we think that this IPO activity probably is near a peak, but even a healthy correction from this pace still offers a lot of choice, and that we see continue.
Right, because it's so good to have, sort of got some perspective from you on the long-term picture of the Indian markets. But we all do know while India is in a structural bull market, any bull market is made up of multiple small cycles, right? With everything that's happening around us, we've sort of, in many ways, ignored. How concerned are you about what's happening geopolitically, or what's happening, maybe a potential slowdown that we are concerned about? Earnings season so far has been okay-ish, no major positive surprises. Do you feel all that could play catch-up? And I know you're not into predicting, but do you feel like the end of the year, or maybe next year, the Nifty may be lower than it is today, only because we borrowed future returns?
So you touched on a few things there. I'll say a couple of things. Number one, though we don't make predictions, we do run scenarios. We think probabilistically. And we spend as much time thinking about what happens if things go really well, especially in a market like India, as we do spending time on thinking about what if things go wrong, how do we lose capital, what are the downside risks. So we think that is a very healthy exercise. Within the realm of expectations for each company that we look at, and as we think probabilistically, we have indeed over the past 2 to 3 years widened out our scenarios. When we look at India in particular, the upside looks like either the probability is higher or the magnitude of the upside could be higher in many of the companies we're looking at. But then given the geopolitical risks that you mentioned, we have lowered the potential downside note as well. We've raised the probabilities for the wings. We've assumed more harsh assumptions for supply chain disruptions, for less pricing power, higher costs of money, the interest rates being higher, inflation being higher. But I would say if 2 years ago, you had told me that there would be armed conflict in Eastern Europe, armed conflict in Western Asia, potential for conflict between large countries out here in Asia, I would be very surprised by the resilience of the markets. No, we can't time any bear market, and this is why we are fully deployed, not sitting on cash. But we are thinking probabilistically, and we have widened out the scenarios. If all the markets in the world were to close today for the year, India would be the only major market in the world, or the only market in the world to have gone up 9 consecutive years. And because the rupee has been generally stable, even foreign investors who are investing in dollar returns will have gotten a large portion of those returns. That's a big difference between India and Japan. Japan has done very well as a market, but the yen has weakened materially. So if you were a dollar investor, you didn't get those returns. So yes, we might have borrowed some future returns, but we're thinking on a 5, 7, 10-year horizon and beyond. We are looking to be aligned with the promoters of these companies that we're meeting. They're making long-term investments, and so are we. A pullback would be healthy, but on the balance of what we know, we'd be adding to our positions rather than panicking.
And I guess hence it becomes difficult to do a sectorial call, but betting on the promoter, and I think that is so important for us to all be mindful of, right? If you're making a significant investment, it's very important to bet on the management and have complete faith in what they're doing. But thank you, Vikas. Great talking to you. I'd love to chat with you longer to understand the style of investing, but maybe that can wait until next time. With that, we're completely out of time on this edition of Talking Point. Thanks for watching.
Hello and welcome. This is Agam Vakil and you're watching the F&O show on NDTV Profit. In this show, we take you through all that is happening in the futures and options space in Indian equity markets. We start by taking a look at benchmarks which are currently trending in the red. There is weakness as far as the Nifty is concerned, but where is the weakness coming in from? Let's take a look at the key constituents of the Nifty 50 right now, and I reckon to a certain extent it certainly will be banks. Well, lo and behold, HDFC Bank and ICICI Bank at the top of that list, with Bajaj Auto taking a sharp cut today. On the other hand, we do have a little bit of firefighting going on from Mphasis, Reliance Industries, as well as TCS, not to forget Tech Mahindra, but all in all, it's not looking like a great day of trade for the Nifty. It's managing to hold on to 24,800, and do remember that 24,800 is a very important level to keep an eye on. Then the reason is that, earlier on in the series, when you actually go and sell that particular 25,000 call, or rather put, you've sold it for maybe 100, 150. That's the premium. Well, now as you go in, you start getting tested in terms of those premiums. In any case, even on the higher end, we do know that there was always a little bit more pressure when it comes to writing in calls in downwards coming through. So at the moment, what we're actually seeing is certainly, weakness. And again, today is also the weekly options expiry. So we've seen 25,000 just take a step away. And currently, we're looking at the Nifty trending at 24,800. But with that said, let's take a look at what the futures and options space is doing. In fact, let's take a look at the futures and see where there's traction. There isn't, in fact, there isn't any traction in the October futures. What about the Bank Nifty? Are we looking at any positions being built there? We are, in fact, looking at a little bit of an uptick when it comes to open interest. So open interest has increased around 3.5%, even as the index comes off by 1% yet again. So there is selling pressure coming in, fresh shorts building into the Bank Nifty futures. But of course, right at the top of that list in terms of big losers on the Nifty 50 today is Bajaj Auto. Bajaj Auto is under pressure. It's down around 10% now. And we now have Puneet joining us to tell us about, while prima facie the numbers looked good, I'm sure there's something in the fine print. Puneet, over to you. Tell us how are things faring here?
Well, definitely, it was a good set of numbers. 22% revenue growth for the company, 24% EBITDA growth. And while the profit growth came in at 9%, there was a one-time impact of about 211 odd crores. And that's purely because of an indexation change of the debt mutual fund scheme as per the Finance Act 2024. So overall, the numbers were good. I think it's the commentary that's gotten the street a bit worried today. And that's why the stock is reacting negatively. So in their guidance and in the conference call, they mentioned that, the motorcycle industry saw growth of just about 1 to 2% during the festive season. So they're including the Navaratri as well as the Dashera period in this particular time. And that's falling short of the expectation of about a 5 to 6% growth that they also had for their own growth as well for Bajaj Auto. Management is hopeful for a demand recovery in this extended period as well as Diwali and Q3 as well. But still, I think on the initial comment is something that's got in the streets nervous. They're expecting an overall demand of the whole festive season to be around the 3 to 5%. That's what Bajaj Auto expects. But when you look at the 125cc segment, they've lost about 300 basis points of their market share. That's one of the key concerns as well. So when you look at the brokerages as well, certain ones such as MK, they've downgraded the stock to a sell from a reduced rating earlier. They were reduced, but the price target has increased to 9,500 from 8,300 earlier. They have mentioned that Q2 results were marginally weak based on the lower average selling prices, and that's probably because increased electric vehicle scooters that have been sold in this particular quarter. Market share losses in 125 is a key concern as mentioned, and they're also preferring something like a Hero MotoCorp and TVS based on valuations for Hero and improved gross profit for someone like a TVS. View of the sell rating continues with Citi. They have a lower target price 7,800 versus 7,900 earlier, and the key thing that they mentioned was they were a tad surprised by the outlook that the management gave on the festive demand and noted that it will be only 1 to 2% as mentioned. But what's interesting interesting is that the retail data, Vahan retail sales have been around 12% growth in this particular time frame. So management's guidance, 1 to 2% is wholesale, basically giving it to dealers. Retail data has been much encouraging, but the commentary suggests that the outlook for H2 as a whole will be slightly lower, and that's one of the key negatives. So I think it's more the expectations that are getting corrected in the market today. Stock has run up more than 100% in the last 1 year, and I think it's the expectations that have not been met because it's a very richly highly stocked. So it used to trade around 19%. That's the 10-year average price to earning. Now it's at 32. So mainly I think that's one of the key things. But overall results were positive. Slight negative commentary might have hurt the stock today. Back to you.
Fair enough. Point taken, Puneet. Thanks so much for joining us and taking us through all the factors that are working in favor of Bajaj Auto and some which are not, and that's possibly provided, well, the street a reason to book profits, because do remember Bajaj has been one of the top gainers as far as this year's concerned, certainly has outperformed the entire auto index and, well, to a certain extent many of its constituents on the Nifty 50 as well. Look at that. It's this year itself it's moved up around 53%. So there you have it, and this is notwithstanding the 10% drop that we've seen. This includes the 10% drop we've seen. But on that note, let's get in our experts for today. We have Nilesh Jain. He is the head AVP at Technical Derivatives Research, as well as at Centrum Broking, and Akshay P. Bhagwat. He's a Senior VP at GM Financial, who joins us on the show. Good morning to both of you. Thanks so much for taking the time out. Nilesh, how are you looking at the Nifty now that it has weakened? Do you think that there could be more weakness in store, or could there be a little bit of pause in this weakness going forward?
Morning, Agam. So it has been a kind of a consolidation. That's what we are witnessing from past 8 to 10 sessions now. Nifty earlier formed a strong base around 24,700. Now, looking at the overall setup today being a weekly expiry, the data suggests that 24,800, where we have witnessed a fresh put writing yesterday, and it has a meaningful OI concentration as well. So I think today's expiry point of view, Nifty may oscillate in the range of 24,800 to 24,900. That can be 100-point expiry range for the Nifty. But overall, going forward, it looks like Nifty may see some more pain from here. If at all it takes out 24,700 on the lower side, then we might see a further drop towards 24,500 levels. And that's the next major support of 100-day moving average. So that might be tested from here. Any pullback towards 25,000 might get sold into. We need a decisive breakout of 25,200 levels to confirm it as a short-term bottom formation. But as of now, there are no signs of it. So yes, we expect some consolidation with slightly negative bias on immediate basis in the Nifty index.
All right, well, there you have it. That's the view coming in on the Nifty. Akshay, good morning to you as well. What is your reading on the Nifty 50?
Good morning, Agam. So Nifty has started the day breaking the support zone of 24,900. That's an intermediary support. Now it is heading for its one of the most vital support, which stands at 24,680 to 700 zone basis spot. Even if you look at India VIX, it has again reversed or bounced from its bottom areas of 13 odd levels, and FII selling continues to keep piling up around 65,000 odd crores in cash, around 33,000 crore in index futures. So overall, the sentiment is negative. The price action also supports this view. And today being the weekly expiry for the Nifty, yes, there can be some bit of volatility. But as the reading goes right now, 24,800 strike input is where the market is mostly heading for. 25,000 shedding is already in, and the call writers are positioning themselves very strongly at the strikes of 25,000. So over and over, the view is weak, and I'm expecting the selling to continue with a resistance of 24,900 for levels till 24,700 from a short-term basis.
All right. So, well, I reckon that 24,700 is the consensus right now, where it seems to be a crucial level, as far as the Nifty is concerned. We're about 150 points away from there. The thing is that it's less than 0.5% away from current market levels. So it's not too far away. And should we see some selling come through, and given the fact that it is also the weekly options expiry, so you can't really rule out that particular drop coming off as well, because another 150 points from here on, it's not a tall order. It's not completely improbable, especially not on a weekly options expiry day. So it's something that we need to bear in mind. Do remember the Nifty is holding on to and defending 24,800 as well. that's going to be an immediate one to keep an eye, considering today is the day where we've seen a little bit of put writing coming in at around 24,800, and the Nifty has not been able to break down below that. But again, it promises to be an interesting one, perhaps a tough one as well for intraday traders. But let's go on and take a look at the Bank Nifty now. Akshay, I'll come back to you on this one. How are you assessing Bank Nifty?
Bank Nifty was the stronger index lately, but if you look at the way the proceedings for the day have started off, clearly the resistance has been seen at the levels of 52,000, where significant call writing bets are placed for the coming weekly and the monthly expiry for the bank index. So that's a very strong hurdle which Bank Nifty has to overcome if you need to see any positive momentum. As it stands right now, the possible support where Bank Nifty is heading for is 51,000. Even if you look at the banking constituents, the recent upswing in Bank Nifty was only supported by HDFC Bank. All the private banks were more or less sideways to negative. Today, State Bank is somewhere or the other showing some signs of life, but overall, the banking pack as such is negative, and you really need support from the heavyweights if Bank Nifty has to take off. So currently, the view is weak. Mostly 51,000 is the support in the making, and that's the downside which I expect in the bank index.
Nilesh, your view on the Bank Nifty?
Agam, Bank Nifty is currently at a very crucial juncture. Historically, it has taken a constant support of its 100-day moving average. And recently also, we have seen a rebound from the same. So as of now, that level is currently placed at 51,500. So till time it doesn't closes below the same, we can expect a kind of a pullback in the Bank Nifty as well. So these are the futures levels for the Bank Nifty. 51,500 is going to act as a very crucial support on the closing basis. And if it, in case it closes below the same, then I think it is likely to test the levels of 51,000 or may slip below that level as well. So overall, the structure is not that promising, but we expect some consolidation in the Bank Nifty as well. We need a decisive breakout above 52,000 for any possibility of a short covering rally towards 52,500 to 53,000. And the broader range as of now for the Bank Nifty looks like 51,000 to 52,000. So that's the 1,000-point trading range. At current levels, there are no trade in the Bank Nifty. So better, I would prefer to wait and watch for some sort of a confirmation in the Bank Nifty.
Absolutely, wait and watch. That's the word coming in as far as the Bank Nifty is concerned. And from there on, we talk about stocks then. Let's pull up all the stocks which are actually seeing an increase in open interest today. I'm sure there'll be plenty more shorts as compared to longs for now. A lot of shorts under pressure. Bajaj Auto right at the top of the list, losing out as much as 10%. 35% added in open interest. It's the same for Hero MotoCorp, which is under pressure as well. This one is also down around 4%, another 10 and 11% added in OI. In fact, it is the auto pack, isn't it, which is completely, getting washed out today. So you have Maruti Suzuki, which is down 2%, M&M, which is down around 2.7% right now, and both these are looking at shorts too. Bharat Heavy Electronics is the other one. Pardon me, BHE, and that's Bharat Heavy Electricals is the other one, also down around 3.5%. Are we looking at unwinding? Well, no surprises there. All of them looking at longs, which are unwinding at the moment. Godrej Properties stands out along with something like an Axis Bank. And Siemens India, just yesterday it made a new high, and it seems like that new high is getting sold into. So a lot of longs were built yesterday, and Siemens India didn't make a new high, but it was trading at the highest levels in the last couple of months. And it does seem like, it was denied entry into a newer zone at the moment. And, for now, we're looking at selling, returning to Siemens India as well, along with the long unwinding coming in. But let's talk about stocks which are on the radar of our experts. Nilesh, back to you on stocks that are looking interesting to you right now.
All right, Agam. So we are having a balanced approach looking at the market volatility. So one buy and one sell. I'll start with the sell first. So JSW Steel is looking slightly on a weaker side. If you look at the Nifty Metal Index, where we have seen a formation of a lower top and lower bottom, and looking at the formation in the dollar index, I think there may be some more pain left for metal space. So JSW Steel short buildup is happening, and it has declined for the fourth consecutive session. We expect further downside to continue. On the lower side, we might see the levels of 946. So that's the immediate target that we are eyeing on. and the stop loss can be placed somewhere around 1001. We have one contra trade, that's a buy in PSU banking space counter SBI. So State Bank of India, this particular stock is showing strength in spite of weakness that we have seen recently in the bank Nifty space. This particular stock have outperformed, and we are witnessing a kind of a short covering move in the State Bank of India. We expect a follow move to continue towards 834. So that's our target. 795. Sorry, 798 will be our stop loss in State Bank of India.
Okay, there you have it. Akshay, what about you? Anything that you find interesting this morning?
I am devising a bear put spread in the Nifty index. You can also use this for hedging your portfolios. The whole idea is that Nifty is heading, and most possibly the make or break level is 24,700, which is more of a decision making level. But till it reaches, I think the bear put strategy should work out. The strategy is devised for the coming weekly expiry, not for today. It is for the 24th October expiry, and we recommend buying a 24,800 put, which would cost you around 129, and simultaneously we sell a deep out of the money 24,500 put at the premium of 50 per lot. The strategy would give you a profit of around 3,000 if Nifty hits around 24,500 by the coming week, and the risk or the stop loss on this strategy would be 1,500 per lot.
So that's a bear put spread at the moment, Akshay. I believe you also have Reliance on your radar.
Oh, yes. So Reliance, if you look at the action in Reliance, it's a heavyweight for the Nifty index. And surprisingly, it is kind of holding its ground, heavily oversold. 2,700 is the point where you see a lot of put writing, consensus support building both for the current October expiry as well as for the November expiry. And my sense is that there has to be a small pullback rally in Reliance, which kind of should save the day temporarily for the market. So here the strategy is to go for buying 2720 calls for the October current expiry. I'm expecting a pullback rally which should see the option premium jumping till 65 to 81 in the short term scenario, and as a risk or stop loss you can keep stop at 29 on the option premium.
Okay. All right, well, from there on, let's take a look at a handful of queries that are coming in from our experts, pardon me, our viewers too. And we're going to take up Titan right at the top, because this one is, and I'll take this one up with Nilesh. So we have Bhanu from Bengaluru, and he says that he has the Titan 3,550 call and has a paid premium of 25, and I'm assuming that this is a long call. This question is, should I exit or no? So this specific call, it does seem like it's more or less making a slight bit of profit. It's the 3,550 call, and the underlying is just about less than 100 points short of going in the money. So it's not going to take too much for the call to go into the money, but it's, it's one of those markets where it's turning out to be it's one of those tough days, to be honest. But the viewer's still looking at, or rather still sitting at a little bit of a profit, considering it's currently trading at 26.7. Nilesh, your view on this specific call?
So Agam, the stock is currently witnessing more sort of consolidation and constantly facing resistance at the higher levels. So 200-day moving average is placed somewhere around 3,525, and today we have witnessed some bit of kind of a short build-up have started building up. So I don't see major downtrend from here, but at the same time don't see any V-shaped kind of recovery as well. So if at all we see any pullback towards 3,500 to 3,520, that will be a good exit for this particular call option. So keep an eye on the underlying. Currently, Titan is hovering near about this 100-day moving average that is placed at 3,480. So any move beyond 3,500 could be a good exit point for the from this particular call option.
Right. Also, moving on to SBI, and I will take this one up with Akshay. So we have Param from Gujarat, who was the SBI 830 call and has paid a premium of 10. Again, the assumption is that it's a long call. Should I exit or should I hold? Let's take a look at where this one is currently. So the 830 call again, a tad bit away. The spot is a tad bit away from going in the money. The spot is currently trading at around 813, and the particular premium stands at around 6.3. So looking at a potential loss at the moment, considering the call was bought at 10 and it's now at around 6.4. We already have Nilesh's view. So Akshay, I'll come to you on SBI. Your view on this particular bank and what could be done with the 830 call.
Well, so SBI has broken its resistance zone as it stands today. So that's a positive development as far as day trading goes. And that's the reason why you have some momentum flowing in this bank counter, despite the fact that banking index is down. Most probably, if this momentum holds on, then this can head for 825 on the upside. But since you have bought an option and options are very time sensitive, I would say that if your holding time frame for the call is till Friday 3:30. So the best case scenario is till tomorrow. If this stock moves till 820.25, that's the point. Your call option should be booked. Most probably that should turn around till maybe 11 or 12 in the best case scenario. That's the point to book profit. And in case you don't get the momentum flowing in by tomorrow's trading session, then you should be taking an exit by Friday's closing. That's the call in SBI.
All right. Well, there you have it. And I think we have time to squeeze in just one more query. So I'm going to take this one up on ICICI Prudential. I'll take this up with Nilesh. Well, we have the ICICI Prudential 760 call, which Ramana has bought at around 15. The question is, should I add? Okay, so all right. So the premium currently is at 12, and this is the 760 call, and the spot is at 745. And Ramana is asking whether or not he should add on to his position. And currently, so the first one he's bought at 12, and currently, the first one he's bought at 15 is currently going at 12. So Nilesh, what should he do? He wants to know if he can add on to the position here.
So Agam, the structure is not looking bad. In fact, it is just out of the money call option. I think if already bought, then stay put, keep a stop loss somewhere around 9 rupees. Currently, it is trading at 12 rupees. As far as underline is concerned, it is currently trading somewhere around 745. And if at all it breaks above 755, that will be considered as a good consolidation breakout. Post then we might see the levels of 770 to 780 as well. But as of now, there are multiple hurdles in this particular stock. I think going forward, we might see a gradual up move. So keep a stick stop loss somewhere around 9. And do not average till the time we don't see any decisive breakout. So better to wait for that confirmation and stay put with your existing long positions.
All right. Well, there you have it. That's the view coming in on ICICI Prudential. And with that, we are going to thank both our experts for joining us and taking us through their views on the markets, giving us a handful of trading ideas. To be honest, a tough trading market, and as well as solving our viewer queries. So, Nilesh and Akshay, thank you so much for joining in. And with that, we shift focus to the commodity space. We have Tejas Anil Shigrekar. He's a senior technical analyst looking at commodities and currencies at Angel One. Tejas, good morning, and thanks so much for joining in. We've seen traction build in gold. How are you reading cues from gold, and what are you dealing with?
When we're talking about the spacious metal, it's completely overbought conditions now, and there is a lack of data that keep coming up from the US. Even the unemployment claim from the evening session, there is again some price recovery could be seen, but we suggest to, as per the technical levels, go for the selling pressure could be seen on the evening session. So 77,250 is a mark to go for the selling pressure, see the selling pressure. Keeping the stop loss 77,470, targeting for these 76,810 to 800.
Right. And moving on, Tejas, what are you doing with silver?
Silver, again, a technically pattern. When we see the bad pattern is already formed on the technical part, even the overbought situation from the other oscillators. So we see the selling pressure at 92,200. Keeping the stop loss 92,950 and targeting for the 91,000 to 90,800 mark.
All right. So sell on two precious metals, gold and silver, Tejas. But what about crude going forward?
crude, when we see this selling pressure keep coming up from the high level around of 6,000 and 6,100 mark. So we having the already proceeding from the lower level, almost the 5,500 mark is a very good support we've seen. So we are keeping the buy beat over here. So on the evening session, we'll see the more good buyers are taking the hold horse. We are giving the buy call here. 5,850 is a buying level, keeping a stop loss of 5,760, targeting for the 6,000 and 6,100.
All right. Well, Tejas, we would have loved to talk more, but we're unfortunately completely out of time. So thank you for joining us and taking us through those key commodities and which are very well traded in the markets right now. So thanks for joining in. And with that, it's a wrap on this edition of the F&O show, but lots more lined up on the other side. Stay tuned to NDTV Profit.
Hello and welcome. You're tuned into the Smith Show here on NDTV Profit. I'm Harsh Saita, with me is Anushi Vakharia, and over the next half an hour we'll have two interesting conversations. Let me first start off with where the Nifty 50 is at. You're at 0.6% odd lower on the benchmark, and pressure right off the bat from the start of the day. If you can pull up the intraday chart, that's what will signify and show. There you go, around 0.6% or thereabout. That's how the gash is looking. In terms of contributors, Reliance, Infi, SBI, L&T contributing positively. L&T on a big order win. Mphasis, numbers expected now. Today. Reliance Industries doing well. So when the heavyweight does well, at least some amount of cushion available for the benchmark index. But what's not doing well? HDFC Bank, Bajaj Auto now slipping 10% plus in trade. ICICI Bank and MNMR. The major culprits where the drags are concerned, and just look at those, just those four, contributing almost 100 plus points in terms of negative contributors. So plenty, just four stocks contributing to over 50% of those negative 200 points contributed on the Nifty 50. Let's pull up the small and mid cap indices as well. pressure there as well. You're looking at the mid-cap index down around 1%, small-cap index also down around 0.5% thereabouts. The breadth of the market looking weak. Let's pull up the advanced decline. That's what will show. Breadth of the market looking quite weak in that sense. Let's quickly switch over to sectors. There you go, 2:1 in favor of the losers. In terms of sectors, you have the Nifty Bank, which is down around 0.8 odd percent. The Nifty Auto taking a plunge, 3% lower. That's the top loser in terms of sectoral indices. The Nifty Realty too down roughly 2.8 odd percent. So pressure on both of those, the Nifty Auto, the Nifty Realty, and you're seeing only the Nifty IT possibly insulating all of the red on that screen in front of you. So that's how the picture is looking. Not a very pretty picture, at least as we stand at the moment today. But let me bring on board Amit Jaiswal, CFO Royal Orchid Hotels, to talk to us about how festive trends are expected to play out. Bookings would have likely started, traction would have picked up. Mr. Jaiswal, welcome, good morning. Want to quickly check in. So how's the traction looking this festive season?
See, the festive season is looking very good. Historically, if you see, the third quarter for our industry, that is the third and the fourth quarter, always has been good. And even this quarter, it is looking very promising. All our leisure hotels have done very well in the last week. We had high ARRs, high occupancies in the last week and so. So, we are poised to do very well going forward this quarter as well as the next quarter.
Hi, Mr. Jaiswal. This is Anushi joining in. Want to address to you now, if you look at the Q1 performance, now if you take the whole hospitality industry in picture, there was a lull in bookings as well as the ARR growth and occupancies. Want to understand from there on for your company, how has the growth picked up from July, August onwards, and what is the sort of ARR growth and the occupancies that we expect for the H2 of FY25?
See, historically, what happens is generally we compare ourselves with last year. Okay, last year, the growth in ARR and occupancies were good. Post-COVID, post the pandemic, we started growing. The industry has grown very well. So has our company. But this year, first quarter was not that great because of elections and the heat waves across the country. So our first quarter were not very good. But the second quarter we started all the hotels have done well